Call meeting order. Call the roll, please. Hang on. Right there.
Carl England, Mark Nonig,
Here.
Jack Prothero,
Here.
Terry Cohey,
Here.
Bruce Nelson,
Here.
Diane Fladmo, here, Maggie Peterson,
Here.
Jeff Greenfield,
Here.
Jim Edwards.
They'll be here at 12:30 or so.
Okay. Senator Sales and Representative Hamilton.
Here. And now it's time on our agenda for notifying you that we are on TV. We're being recorded on video. Please keep that in mind. And then followed by public comment, any issues within the board's jurisdiction that are not on the agenda. Anyone from the public that wishes to make a comment, take it forward. Seeing none, we move to the minutes of the April 2019 meeting. Is there any discussion or a motion on that?
I make a motion to approve the minutes.
I would second that.
Move to second, any further discussion? In favor, say aye.
Aye.
Opposed, no. Motion carries. All right, let's go to the committee reports, starting with the audit committee.
See, I'm the audit committee chair now.
You are?
Terry and I switched, yeah.
Why is that?
Well,
Oh, you
ask
just
Terry.
did?
No, just kidding.
All right.
She talked me into it. But anyhow, at our meeting, we reviewed our checklist that staff puts together for us and updated that. We received a written report from Executive Director Villa on the audit findings and actions that have been taken to date. They notified us that we received an information request from the IRS in relationship to Intercap Series tender option bond compliance. That's a mouthful. And I just want to point out for everybody that it's a random request, and probably because we're the only ones in the state that have this. So, we talked about our weekly SOC report. I don't know if everybody remembers what that is, but I think the whole board was there, so I don't have to go into too much detail. They began their planning and field work for June 30th. They requested some information from staff, and I'm sure they'll provide that to them. They're scheduled to return here then on July 29th. LAB compliance is the next item that we talked about, and they're scheduled to be on site beginning June 17th for their audit planning. We then talked about that weekly report, talked about the exceptions they found. We've heard all these before, but I will go through them real quickly. The first one is that password protocols were a problem, and apparently this wasn't just a problem here, but with the state, they've now corrected those. They talked about disaster recovery plan. We've renamed that backup operations, and they wanted us to put in a business contingency plan, and according to my conversation with Julie, they are working on that, and that should be completed somewhere in the near future. We don't care about that. We then talked about STIP reserve, our STIP reserve. John presented to us on that on SIVs, they're called, structured investment vehicles that apparently had, during the market crisis, had become questionable. And the important thing for you to know here is that it looks like we're going to recover 91 cents on the dollar potentially, which is awesome. And that equates to about $5.75 million. So those were previously written down, and thanks to John and other staff, this is going to recoup some funds for our reserve. That's my report, Mr. Chair.
Thank you. Are there any questions or comments? All right, thank you. To the Human Resources.
The HR committee approved the pay plan policy revisions, but we do need a full board vote on that. Dan can give us a brief description of it.
So, Mr. Chair, members of the committee, part of our education and work plan is each May we review the exempt staff salaries as well as the exempt staff hires. Part of that is the adoption of the new salary surveys completed by McLeod and Aon as well as I. Bailey and the Montana-Wyoming Banker Salary Survey. The policy before you simply updates the markets for the respective positions that have been presented to the board.
Do you have a motion?
I would move for approval.
Second.
Moved and seconded. Any discussion? I think everybody was there with mentions. All right, all those in favor say aye.
Aye.
Opposed, no. That motion carries.
Secondly, the committee approved the exempt staff pay reviews and recommendation as shown on the chart we received. And we do need full board approval for that also.
So moved. Approval.
And seconded. Discussion on that. In favor say aye.
Aye.
Opposed, no. That one carries.
And the last one is we approved, and again, this will need full board approval, the revised organization chart and the exempt positions. I was a little confused why we were adopting or why we needed to vote on an org chart that turns out traditionally that's what the board has done. So I think everybody has those changes in the chart. Does anybody need a description from Dan or?
Mr. Chair, that in summary, it would include hiring Michael Wynn, John Ramasco, and Jason Brent as exempt positions of the board, as well as the reorganizational structure and the new lines that are in your packet.
I think the board actually approved the initial chart and then been involved in it ever since, but is there any further comment or discussion about, we had the motion, did we not, and the second?
Yeah.
Did we or did
No,
we
we have
not?
No, but I would make that
Anyone?
motion, Mr. Chair.
I spaced that out, so someone else leave. We can- Go ahead.
Second.
And second. Moved and seconded now. Discussion. Seeing none, all those in favor say aye.
Aye.
Opposed, no. Carries. All right. Anything else on the HR?
That was it.
All right. That brings us to the loan committee. Jack.
Okay, the loan committee met, we had a request for in the intercap loan program from the city of Billings. They need to expand their police evidence building. So the loan request for intercap was $3,410,000 to do that on a 15-year loan. And so the loan committee approved that, and the city of Billings has strong financial positions for payment. That was within loan committee's approval, so we do not need the full board approval. But is there any questions on that? If not, also in the loan committee, we looked at the intercap loan policy program. The legislature passed House Bill 299, which released the dollar restrictions and non-marketability opinion requirements for special and rural improvement districts. That gives us a little more flexibility approving loans in that program for those districts that apply to us. And so to comply with the legislation, the loan committee approved that. And so on behalf of the loan committee, I make a motion to the full board to update the intercap loan program for those special and rural improvement districts.
For a second.
Second.
Is there any more discussion, or any discussion for that matter? Seeing none, all those in favor say aye.
Aye.
Opposed, no. That one carries as well, Jack.
Okay, and then we went to the state loan programs. We have various loan programs that we needed to update the policy. There's no substantial changes, but on the commercial loan policy, we did change some things in that so that loan reservations without an identified borrower are no longer accepted, so we want to know who the borrower is. And then appraisal requirements, we required appraisal when the loan was over $250,000. We increased that to $500,000. That's pretty standard for the lenders we work with. There's still a requirement that the lender provide a basis for value, but not the formal appraisal. So we did that on the commercial loan package. policies. We also did that on investment infrastructure loan policies. And finally, we updated the policies on value-added loan package. And again, no substantial things other than that appraisal, and to make sure we were in compliance with laws that may have been passed by the recent legislature, that our policies are in compliance with those new rules. So again, the loan committee formally approved those 3 policy packages, and so I make a motion to the full board to accept those approvals on the 3 packages and approval.
I guess we should note that there were some oral modifications.
Yes. And so that approval would be with those modifications where we changed some requirements on changing the interest rate. Some of the programs, you get a lower interest rate if you increase job. And we made that a little less restrictive and more at the discretion of the board.
Actually, it was 10 jobs and may increase the rate. We took out the 10, as I recall. And then there were some other grammatical or technical changes.
There will be grammatical changes.
One of our board members has volunteered to address for us. So with that,
Board director and
with that,
reservations.
With that caveat,
is there a second?
Second.
Is there further discussion or any discussion for that matter? All those in favor say aye.
Aye.
Opposed, no. That motion carries.
okay. And then we have another loan request to do a program with our master loan program for Bighorn Valley Health Center. And so Adam Gill is the person that takes care of that program. And we fund a reserve, loan to that reserve if there is some problems. So Adam is going to come up and discuss the program quickly for us for the record.
Welcome, Adam.
Thank you, Mr. Chairman, members of the board. Very briefly on the program and the financing. The Montana Facility Finance Authority provides nonprofit healthcare providers with access to the tax-exempt bond market in order to help them contain their capital costs and therefore contain healthcare costs within the state. One of the programs that we do in coordination with the Board of Investments is the Master Loan Program. It allows small, well-run healthcare facilities to access the market with the credit or the guarantee from Board of Investments, thereby letting them use the quality bond rating from the Board of Investments. This gives them very favorable terms, much lower interest rates, and thereby saves them a significant amount of money than they would if they went out there on their own. And the way the guarantee works is that we have a guarantee on the debt service reserve from the Board of Investments. If the borrower ever falls below their debt service reserve, the Board of Investments will loan the authority the funds to refill the reserve. We've been doing this program for 25 years. We have structured $215 million in bonds. We have never triggered this provision. We have, the authority itself has structured $3.3 billion in financings over 35 years. We have never had a bond default. Not on wood. This isn't wood, this is laminate. Let's right over here. That being said, this particular financing is up to $4.5 million for the Bighorn Valley Health Center in Hardin. It's a primary care clinic that will include substance abuse treatment, dental services, and primary preventative care, primarily for low-income and hard-to-serve residents of Hardin, Montana, and the surrounding community.
Thank you. Anybody have any questions? Appreciate the presentation.
So the loan committee did formally approve this $4.5 million request. So I'd make a motion to have the full board also concur in that request.
Mr. Chairman,
Second.
I need to recuse myself.
Okay.
I will second
All
that.
right, Carrie?
I'm recusing myself.
I just want you to be able to say that for the record. Okay. And give reasons if you wanted to.
I have a financial relationship with D.A. Davidson.
Good. I mean, good for disclosing that, thank you. Any other discussion? Seeing none, all those in favor say aye.
Aye.
Opposed, no. Motion carries.
And I think that concludes the loan committee report.
Are we right on time, are we not? Are we, Smith, how much from TRS and PGRS coordinators, who's going to take that one first?
Maggie?
You didn't trade off on that one?
No, but I do have to tell everybody up
Ladies.
front that I missed the meeting because I was at a forum for PERS, but I did sit down and listen to that entire meeting that was recorded. So
Good for you.
that's why I didn't go first today. Just very briefly, we approved our 2020 budget. The upside of that is that it looks like we're probably going to have about a $3 million excess in the 19 budget, which will then go towards the trust to help offset some of the unfunded liability. We had a local government, the School District 31 out of Nye joined PERS, and we had Sweetgrass County adopt the 457 plan. And that's about it. It was pretty brief.
Questions? All right.
Question, if the school district were not with PRS, do they have can they opt out of being in PRS?
I have no idea if they can opt out. We approve them when they sign contracts. They have to sign local government,
You
as
can
a local
join.
government.
You can't get out.
Oh, okay, 'cause-
Well, they can't get out without paying their unfunded
Right.
liability, which is not affordable.
Anything else? All right. Thank you.
Our teacher's retirement system met about 11 days ago, and we also looked at budget. Our budget for next year actually is going to be a bit higher. A lot of that is one-time costs related to moving to the new facility, majority of which is construction / remodeling. To be able to move into that, of course, part of that being part of the government, you have to use their services in certain situations, so IT had to be their cables and their specs and their people, so that was an additional cost as well. But again, most of that will be because of the move. The move to that new facility has been moved back a little bit, end of July instead of the beginning of July. And that will allow them to guarantee that all the IT things will be in place, so we can move over a weekend and business as usual on the next day. Yeah, right. So I'm looking forward to that. We'll see how that goes. Be good for the employees.
How far are you actually moving?
From right about the Capitol there over to Park Avenue.
Yeah, okay, because it's a Port Investments building, right?
Right. Right, and TRS actually owns the building we're in right now. But, so that was a struggle actually for a year and a half, 2 years.
So what happens to that building?
Well, good question. What we're probably going to do is do a bit of remodeling, asbestos type things, and we will probably lease that to another state agency,
Okay.
at least for a while. Being on the campus in the capital area, the likelihood of being able to sell that without people having a real fit is small. So it seemed like the best course.
Joe's just real nervous right now that Sean's going to make an ask.
Anything else on,
Yeah,
go ahead.
yeah. So
Didn't mean to interrupt.
that's all right. Another thing we looked at were some external contracts that we deal with, one being for tax counsel, and another, we, on an ongoing, regular basis, have a peer review of the actuary audit of our system. So we audit the audit, and that contract, one of, again, many things you jump through that at extra expense. It's going to be about $35,000 to do that, but just to make sure everything's on the up and up. The tax counsel, Ice Miller, we've used for decades, and they are not local, no, but they're tops in the nation. So when we need it, especially during legislative years, we get the tax counsel. Again, the date for moving is pushed back. Our next meeting is scheduled to be in August, beginning of August, I believe the 1st of August. And the majority of that will be looking at long-range strategic planning. So that will be exciting, and I'm looking forward to it.
In your new dig.
Yes, our new leader.
Got a question?
Department report.
Is Is that?
Thank
you so much.
I gotta get some more alcohol.
Anybody have anything to discuss? All right, good. Board liaisons, legislative liaisons. Senator Sales isn't here, so you get the spotlight, sir.
Well, the session ended on April 25th, thank goodness. And as you've already mentioned, there are a few bills that might be of interest to the Board of Investments. One was HB 299. The other one we discussed in the Loan Committee, HB 476. Whether that ever is taken advantage of or not, we'll see. And perhaps the sleeper bill, but I think will be real significant, is HB 715. 715 is sort of a study bill, mostly a study bill, I think. Part of it is stress testing on the pensions, and then personal services budgeting and how that occurs for the next budget. That was a source of a lot of friction and discussion this time, so we'll see what comes from that. But that might be something that you want to keep an eye on. The Legislative Finance Council will be studying.
Personal services, what?
It's actually Dan can probably do a better job of this than I can, so I'll let Dan do
For
it.
the board or for in general?
Well, it's in general in state agencies.
All state agencies.
All right, that's what I was wondering, so.
Yeah, they are several members of the Legislative Finance Committee were upset about the automatic adjustments that take place within the personal services budget every budget. For some reason, there's this hangover belief that the only salary adjustments that happen to 11,000 people is what the legislature votes on. And we're still not past that. I'm sure you dealt with it when you were head of the LFC. So they want to look at it. If they can come up, if they can reinvent this wheel or create a better mousetrap, we'll see. But this is probably the third or fourth time it's been looked at since I've been around. And we'll see what happens.
Okay.
So it's Legislative Finance Council, which will be studying both of those issues, and they've formed subcommittees, and both of those issues happen to be in the same subcommittee, which I'm hoping to be on myself. Legislative liaisons, in a kind of odd little quirk, I was reappointed at the end of the year for the next calendar year, but then at the end of the session, I had to be reappointed again for some time period, the interim, I think. And as we left the session, Senator Sales had not appointed anyone yet, and I don't know what the plan is there, but he'll be otherwise occupied, so I suspect he's going to appoint somebody else. But
He, in the Senate, the rules are different. The Committee on Committees makes the interim appointments. There is an ongoing debate within the Committee on Committees as to who should fill the Senate. The way the statute is written, if one chamber appoints a Democrat, the other chamber has to appoint a Republican. There is a discussion within the Committee on Committees as to who the Senate Republican should be.
and that's all I have.
Interesting. That's all you have? Is that what you said?
Yes.
Okay, thank you very much. Questions for Representative Hammond? All right, thank you. That brings us to introduction by Dan Zarlik. Dan, you're on front.
Yes, Mr. Chairman, board members, I would like to introduce Nathan Finch. He's our student intern. And so he's going to school at MSU in Bozeman. Just finished up his sophomore year. He's pursuing a business finance and accounting degree and probably a couple other things. And you know, his family comes from Missoula, because that's where he finished up high school. And so we're really excited to have him on board and work for us.
Welcome, Nathan. Thank you. Thank you. All right, we're to executive director reports, I believe.
All right, Mr. Chairman, members of the committee, you have my report. You have the monthly snapshot next month. Given the several revisions we've made to the snapshot, or I guess not next month, in August at our next meeting, Mike Pettit will present what those changes were. You have the memo on Montana buildings relative to the landlord-tenant holdings. I think that speaks for itself. Happy to entertain any conversations the board may have about that topic. Certainly we're going to try to fulfill our fiduciary duty relative to our Montana properties. You have a brief memo on the budget status. Yes.
But the vacant lot here close to us,
Mm-hmm.
can you talk about that?
Do you want what I call it, or should I just refer to it as the vacant lot?
Remember on TV?
Yeah. So there is no return for that, and quite frankly, given the experience that we're going through on the TRS model of trying to build something within the city of Helena, it is extremely challenging. So to the extent that we're able to use that property to leverage actual return, we're going to start looking at that. Now there are some, I'll call it ESG concerns, because a large portion of the neighborhood uses that as a walking path to cut through. So there's going to be some neighborhood issues surrounding anything we do with that, but it's yielding us 0%. And it's actually a cost, so holding it, I don't know, without looking at what all of the alternatives may be, is in our best interest, but certainly no action is, from my perspective and from the deputy director's perspective, inadvisable in the long term.
I guess there might be some appreciation, which isn't actually realized.
If we can find a buyer for a very steep slope between a school and a hotel. I mean, maybe Canopy wants to buy it from us as a production facility. Fiscal 19, I'm sorry, any other questions on our landlord-tenant relations? If not, budget status expenditure review, I did have a brief analysis in there for you. Our issues within the investment side have largely been resolved, in no small part thanks to our partners at the Department of Commerce. On the other side, we did have a number of personal services payouts over the year in the bond side. That is what we're catching up with. We'll have some burn on working capital within that fund. We are charging the spread necessary within that world to make up the difference over the longer term. As we build the 2020 budget, there will be changes in the personal services allocation and the operations side, so that I'm confident with it, not by the end of this fiscal year, but by the end of next fiscal year, we can get that fund back to where it needs to be. So any questions on budget? Seeing none. Staffing level we've already discussed, organizational chart we've already discussed, and you have the website traffic, Mr. Chair.
Any questions? We're going all the way to the lunch break.
So right now, Mr. Chairman, this is the meeting every year where you meet with the principal investment clients, and rather than having presentations, we've decided we're just going to turn this into a lunch conversation. So what we'll do, lunch, if we could have board and our partners go into the small conference room, lunch is available in there, go through, come back in here, we'll rearrange the tables for our partner groups to sit around the table with us, have a small chat, and then we'll reconvene back in here at 1 o'clock for the remainder of the meeting.
All right. Lunch. We are adjourned to lunch.
We are adjourned to lunch.
Partners identified.
So we'll do that when
We're ready now. All right, call the meeting back to order.
All right. Mr. Vice Chairman, members of the board, we're on tab 3. And I know the deep dive presentation you've been waiting for all year, fixed income, internally managed. We're going to have a particular focus on non-pension clients this go around. So we're going to go through the slide deck reasonably quickly, but feel free to jump in and ask questions at any point in time. And then hopefully we'll get to a demo at the end where we'll try to spend a little bit more time and show you a lot of different tools that we use on a day-to-day basis. So moving to slide 3, non-pension clients. So this page, really this is the clients that have individual policy statements. So primarily our separately managed investments in addition to full severance tax trust and state fund. We've got it broken down into kind of some broad categories here: our permanent trust funds, our expendable trusts, insurance funds, operating bonds. Those are kind of the big four areas where we have separately managed investments. And this is not a static list, so we do add things from time to time. Most recently, last year, we added the Belt Water Treatment Plant Fund. And we've got about 39 names on the page here. There are actually about 60 plus separate accounts because some of them, like Historical Society, have multiple accounts under that same plan. So there are no other questions there. Moving to slide 4, policy and portfolio construction. So whenever we get a new account or we're talking to existing accounts, to kind of to Jack's point earlier, it's a process of talking to the client, determining what their needs are, giving them information to understand what their options are that we can help them with, and we generally have a particular focus on their cash flows and particularly the certainty of those cash flows over time really tends to guide the investment decision. We'll also note that all team members participate in portfolio management, so what that means is everybody has some assigned clients that they are the primary for. There's an assigned backup for every one of those accounts so that if they're out, somebody else knows what's going on. There's kind of a regular workflow to the monitoring and rebalancing that we do at least monthly, and then kind of on a more irregular basis, we have meetings with clients, either as they're calling us and requesting something, or we may have particular things. So just to note a few, we probably had more than a dozen kind of what I'll term more major meetings last year. State Fund Board meeting, that Noxious Youth Management Advisory Council we presented to, Youth Area Redevelopment Trust Fund. John and Kirsten consulted with NRD and UQ on several accounts, both existing and potential new ones. Met with MSU and MUS Work Comp Group. So just a few examples of the different things that we might do over the course of the year. Questions on policy and portfolio construction? The types of investments that we use, so trust fund, investment pool. One of the main considerations here that we always talk to clients about is if we're going to have an allocation to trust fund investment pool, we'd like that investment to be stable for 5 years or more because we don't want them to recognize short-term losses. Trust fund investment pool, obviously, we think there's going to be better return over a long period of time, but we also know that there's increased interest rate risk and credit risk in that pool, so we want them to get the benefit of those long-term returns and not have to pull money out at an inopportune moment. Individual holdings, we do that generally whenever there's a specific cash flow need, so most often that would come up with, say, the environmental remediation accounts where we know there's a very specific cash flow, they need something on a particular date. We'll drop a treasury agency there to make sure that they have that money when needed.
On those, when you have an individual one, the risk is higher, I assume. And in the portfolio, we get diversification. So does it make sense to do a lot of individual holdings?
So you'll recall over the last couple of years where we kind of redid the policy statements, we did have some accounts that had individual corporate securities in there. We have gone through that process now. We don't have anybody who's got individual corporate securities. Anything that's an individual security, I should say outside of state fund, which would be the one kind of big exception, but unique in a much bigger account. Everybody else would have either a treasury or agency and not take on that idiosyncratic risk, which is part of the reason we moved them to trust fund in most instances when we backed away from that. STIP, of course, is the standard option, highly liquid, heavy weight in that if there's immediate spending needs or if there's uncertainty within their cash flows. And so page 6 kind of shows where things are allocated across those different accounts. Would note here individual holdings, as noted, the majority of that line is state fund. So pretty much everything they have is individual, but they're very large, our largest account. And again, recall that we simplified that structure across other entities, so we don't have those individual corporates. Happy to take any other questions up to this point. Otherwise, I will turn it over to the self-proclaimed face of MBOI, Mr. John Mosco.
Thank you, John. Turning to slide 7, the trust fund investment pool. Before 1995, all of the accounts had individual securities in them. In 1995, we created the trust fund bond pool. At that time, it was called, since the name's been changed to the trust fund investment pool. But it was set up to kind of to Jack's point, to diversify the risk of those individual securities in a separate account. So the investment objectives are to diversify the risk and to provide a decent return going forward. On slide 8, you can see that the large majority of the assets in the trust fund investment pool is the the internally managed investment grade securities. We also have high yield securities, which helps increase the yield somewhat in the pool, and an allocation to real estate that both increases the yield and also adds a little diversity. Going on to slide 9, we mentioned that we try to get a good return for the clients. You can see in slide 9 how we attempt to do that. You'll note that we're significantly overweight the index in terms of corporates. Corporates yield a little bit more, so we're trying to get our yield advantage there. Yes, ma'am.
Can I ask a question, and maybe you're just going to hit it, but I was surprised by the BBB, amount of BBB we have. Is that our junk bond holdings?
So triple B, below triple B is junk.
Oh, so that's still investment grade?
Right, so triple B minus is the lowest level of investment grade. And, but to your point, we do attempt to get additional yield by owning a significant amount of triple Bs. And we'll talk about that a little bit later. Going on to the slide 10, the takeaway from this is, even though we try to increase the yield as much as is prudent, you'll note that the rate of distribution has gone down over the years. We do expect that that's going to continue to go down, but at a slowing pace, at a moderating pace, as we approach more market level yields. Any questions on the trust fund investment pool? If not, I'll turn it back over to John.
So slide 11, state fund. State fund is our largest non-pension client. They have their own policy statement, as you know. They've got a more complex structure than most of our other accounts. Income is an important component to them, but they also want to grow assets to the extent possible within their regulatory constraints. And so if we look at slide 12, when we look at their asset allocation, we note that, as I think you're aware, outside of pensions, they're the only account that can be invested in common equities. And so we have a relatively small allocation there, but it has been an important piece in growing assets over the last few years that they've had that. Core real estate, which was added a little more recently, has also been a good diversifier for the portfolio and has had good returns as well. But as you can see, the majority is still in investment grade fixed income. So if we look at page 13, this focuses just on the characteristics of the bond portfolio portion of state fund. And on the left, when the sector weights, kind of as John noted, within trust funds, similar story here. They're generally overweight corporates, so try to pick up a little additional return at the expense kind of treasuries, a little fewer treasuries. If we look at the right-hand side, credit quality, so naturally we're a little underweight, AAAs as we're underweight treasuries, but we tend to be, somewhat up in quality within overall corporates. You can see that we're kind of a double weight in double A's, kind of close to a double weight in single A's, a little overweight triple B's, but I would note that we'll kind of lean towards the higher quality triple B's over time, and we'll show that a little bit in a little about that. And I would also note here that kind of part and parcel to the regulatory constraints, the state fund does have a 25% limit on triple B, so that's something we're always aware of as well. Yes,
Just a question. You said we own individual holdings, so what would be a position size for an individual holding within state fund?
So the total portfolio is about $1.5 billion. I would say most of the corporate holdings are probably somewhere between $10 to $15 million. In a name, I should maybe say, so maybe that's, you know, a couple of maturities, $5 million or something. Any other questions on state fund? Over to Kirsten to talk about STIP a little bit.
Great. Good news, we did the STIP deep dive recently, so I'm going to skip ahead to 15 because our objectives have not changed since we last talked about it. Unlike the trust fund, we purposely didn't include a snapshot listing all of the STIP clients. We have almost 500 accounts in STIP. Wanted to bring that up mainly because a big portion of the work in those accounts fall to our accounting team. So I liked, I don't know, someone come over here, Julie's here. So I like to bring that up. They're a huge reason we get it right every day in STIP. Another part of getting it right every day is our disaster recovery, which now has a new name, I guess. But we also talk about that in another meeting, but I like to bring it up in case you have any questions about it. Seeing none, I will point out the one characteristic that I wanted to touch on here. $650 million in daily liquidity. That's more than our top 5 cities and counties. That means theoretically, all 5 of them could come to us in a single day and say we're pulling our money out of STIP. Not that I would ever expect that to happen. I want to give you some comfort knowing that we could do that. And then moving on to slide 16 here, I will say since we made this book, the second bullet point here, current market expectations have changed slightly. We might see a small decrease in the yield of STIP in the near or term future, maybe the next year, depending again on market expectations. And then, are there any questions about that? Great. Moving to page 17, here we're showing you an overview of all of the internal fixed income portfolios. You can see about a quarter of what we do on the fixed income team is in the pension, and then what we're talking about today is this other 3/4 here. The second point, we put all the transactions we've done in the last 12 months here. There's a lot of them, right? Mostly in STIP. Again, we like to put this in here to give a thank you to accounting and investment operations.
Am I reading that correctly as 27,720 million
Yes.
of transactions?
Yes.
Wow.
Again, almost 25 billion in STIP, and that's not buying and selling, it's mainly buying, rolling off and buying. And that's, you know, STIP is $3.9 billion, and we might have 100 million a day mature, and that could be 3 or 4 trades a day. And again, I say thank you to accounting and investment operations, Kelsey and Tim specifically, because all of those trades also need to be approved and booked through our system. So it's a lot of time for them.
That was the blooper screens that you showed a couple meetings ago.
Mm-hmm. Yeah.
Okay.
Yeah, so I'd say,
Now I know what I was looking at.
yeah, almost all of those are done electronically. It's very rare that I would, unless they're a little longer, talk to a broker to do the trade. Just, there's not enough time in the day.
Quick question. So are all of the requests to buy and sell at the local government level coming in electronically now? Is that all?
Yes, and Julie might be able to explain their system.
Yeah, Terry, The participant side goes through our electronic STIF web portal. So our participants, whether it be a state agency or a local government, are going out. If they do the request by 2 o'clock today, they have their money tomorrow. And they can also future date it if they so choose.
So you've got everybody finally on the system and it's all working.
Great, well, there are no more questions about STIF or our internal portfolio, so I'll hand it to John.
Just ask one. We talked about the SIVs before, and so I know we've got a lot of control, so hopefully that never happens. But if you get worried about a particular position, have you been worried enough that you wanted to sell them underwater, or, I mean, I guess I want to see how, if you're worried, what do you do?
If I were worried, I would sell, but I haven't been worried about any of our positions since I've taken over STIF to sell anything.
So are you a worrier?
I am. Definitely would consider myself a warrior. And it does help that we go through the list of approved names. So we have taken names off of our approved list since I've been here, and that's probably where we would do that more likely, take a name off of the approved list and wouldn't buy it going forward. So we do that at least twice a year with risk management and investment operations.
I will go. Turning to slide 18, fixed income at its heart is a contractual obligation for an issuer to pay principal and interest over time. A core bond would be have a coupon. So if you buy a bond and at a particular yield and hold it to maturity, the return on that security does not change over time. It stays, for instance, 3.5%, so kind of why we call it fixed income. Wanted to talk about terminology just a little bit. A couple of things that you hear us talk about is duration. So kind of wanted to flip forward to slide 24. Duration is a measure of the interest rate sensitivity of a bond, so that if overall interest rates go up, the value of the bond goes down, and vice versa. For instance, you might hear us say this portfolio has a duration of 5, so that if interest rates were to go up 100 basis points or 1%, then the value of that portfolio would go down 5%. So that in a nutshell is duration.
What's your target?
What is the target? So it is more in relation to the underlying index. So for instance, let's just talk about the trust fund investment pool. The duration of the index might be 5.9. And so we would say all other things equal, we want to be 5.9. But if we said, well, I think interest rates are going to go up, then we would want to be short, significantly short, if we had conviction, or vice versa. If we thought interest rates were not going to change and there was a positive sloping yield curve, we want to be long. And so generally the target is the index.
And that changes regularly.
It does. And so we are regularly, as Kirsten
Which is
showed.
why you're doing trades all the time.
So within policy,
Right.
pretty much all of our portfolios is plus or minus 20% of the index. So that's kind of the range of what we could do.
That's a lot of trade.
It's a fair amount of range. I would say most of the time. The longest I can, the furthest away I can ever think of us, remember us getting was about 15%. And that was probably the biggest extreme for us. We don't tend to take real big duration bets. It's a difficult call to make most of the time. You know, you're making a bet on what the Federal Reserve is going to do, where interest rates are going to go. It's a tough game to play sometimes. So definitely pay a lot of attention to it, but we have to have a lot of conviction to wait that long for that short.
Terry? Question, on page 15, you're talking about the duration of the STIP, 0.09 years, obviously very short. When you were using that example for 5, were you talking years or a different measurement?
So, John would punch me in the mouth if I said years. It is, people do say years, it does not equate to years.
Yeah, that's what I'm having trouble with. You know, with it.
So it is a mathematical equation. When all the denominators and numerators fall out, you could technically call it years, but that's not what it is. We just use a numeral.
Okay, got it. Or not got it, but probably did.
So it's a factor, if you will. Another thing that you hear us talk about is spread. Spread is a measure of the difference between the yield in a non-treasury bond and the equivalent U.S. treasury bond, or risk-free investment. And so a spread is, if you will, the risk premium that we demand to own something other than a treasury. Going on to page 22, the objectives of fixed income. The primary objective is total return. Of that total return, most of it is from income, from coupon type payments, but also you get plus or minus the change in market value. Over time, the large majority of the return is just from the income payments. Also, you get diversification. Their fixed income has a different risk profile than equities or real estate or other things. Also, liquidity. In times of stress, you might be able to sell bonds, especially treasuries, easier than you can sell stocks. And also, keep in mind that even in times of stress, you get coupon payments and maturities, which can be a significant source of liquidity.
So you're more likely to keep something till maturity during the time of
well, no, but you'll be happy, not necessarily, because there's a lot of decisions to be made whether you buy or sell a security, but you would be happy if you had a lot of short-term maturities coming in.
So it might be easier to sell, like treasuries obviously are very liquid, and oftentimes in a crisis, treasuries would rally. They would be doing very well. So that might be, that's more often the obvious choice, I guess, if you will, that you could sell an equity, so they might be down 30%. So that's not a very attractive proposition. So you might sell treasuries, which have actually appreciated in value, and kind of reallocate to equities would be kind of a classic example, I guess. But like John said, there's factors there.
Going on to slide 23, primary risk factors. So our goal was not to bore you into submission there. So maybe I'll use an example for an illustration. Here several weeks ago, Kirsten brought to the team Starbucks as a name to add to the approved list, and the team concurred, mostly because it landed in my coverage area. But it looked like a really good value.
So you're buying.
So, right. So, interestingly, the very next day, Starbucks came with a new issue. They wanted to issue new bonds and proposed it to the market. So, we looked at that. One of the first things we looked at is, okay, what's the size of the offering? Is it going to be big? Is it going to be benchmark-like? It was. We were confident we were going to get something, close to $1 billion in an offering. So not a ton of liquidity risk there. We thought those would be easily marketable going forward. The next thing we
think about is the risk-free rate of return. Again, that changes daily, but we can look at the treasury curve and well, more particularly short treasuries we'll look at, and then we'll think about, okay, how much more risk does inflation add? Well, like now at that time, in early May, there wasn't, the market did not anticipate much inflation, and so only very little inflation risk to be added to the risk-free rate of return to get to where we would want to be. Maturity risk, there were several issues, several tenors, 3 years, 5 years, 7 years, 10 years. We thought we would look at the 10-year because that looked like the best bang for your buck for maturity risk. And then the key, generally for a corporate, the key is the default risk. And so we looked at that. Kirsten's going to kind of show you mechanically how we did that, but point being is we came up with an estimate in that we would accept 95 basis points over and above the 10-year treasury as an acceptable level. We thought about that a little bit, noticed, oh wait, spreads widened a little bit yesterday, so then we said, wait, 98 basis points. So we put in an order for 75 million of the 10-year, thinking that we would probably get around 30 million or so, I guess. The ultimate price of it was 103 over and above the 10-year treasury, so pretty good price when we were willing to accept 98. We got 55 million, which was a bit of a surprise, but we never put in for anything more than it's going to violate the policy. And so we ended up with 55 million of Starbucks for the portfolios. So that's just an illustration of how we think about the risks and how we add them up and eventually come up with a buy or sell offer. So I guess you better drink some coffee. Right.
So how did Starbucks, have you kind of been following this? How did Starbucks end up on your radar screen?
Yeah, so I used to cover the sector that John has now, and so I had been watching the name for a while, but they didn't have a lot of debt outstanding, so I never had the time to kind of take a deep dive into it. I finally did. Went through, we'll show you our credit matrix, so did all the analysis, the credit analysis of it, brought it to our food and beverage meeting thinking that's where it still would fall, but it's actually under restaurants, which falls into John's sectors now, so kind of a slip up on me, but you know, John and John agreed that the credit metrics are strong for the company, so it's a name we can follow and add it to our approved list, so. We did end up buying it after all. I don't purposely look for names down to John's list, usually.
Bravo.
Right. Good timing. Yeah.
Any other questions on fixed income basics? If not, then I would turn it back over to John to talk about investment philosophy.
So on slide 25, investment philosophy, just a couple points I would emphasize. So we do have a long-term focus. You know, we're a pension fund, or we've got permanent trust funds, or a state fund, all pretty long-term time horizons. You know, all of those funds, and the vast majority of all of our funds are really in perpetuity. So focused on the longer term. We definitely try to avoid credit problems. You know, in fixed income, best we can do is get our principal back and collect our coupon or our interest payments. The worst we can do is it defaults and we get a zero, which is pretty hard to make up in the longer term world of fixed income at this point. Other point I would make here is trading costs should be minimized. So the bond market is still an over-the-counter market. It's not like equities. You need to find a willing buyer and a seller, and that is not always possible in this world. The bid-ask spread when we go to the brokers can be wide, can be relatively expensive. So what we, you know, kind of they earn the spread essentially by buying it from somebody else selling it to us. And so we need to be cognizant of that and have a good reason to trade, make sure that it's, adding value to the portfolio. So despite the fact that we did whatever it was, $20 billion last year, most of that's more in the short term end where, as Kirsten said, we're kind of reinvesting. We don't tend to churn the portfolios a lot for that reason. Fixed income resources on the next page. Not going to really spend a lot of time here, but we will show you a number of these when we get to the demo here and put a bunch of these up on the screen. Again, like Kirsten said, we just kind of give a shout out to operations, accounting, risk management, where we get a lot of help throughout the year, particularly in processing whatever trades we may have done. So definitely a lot of work. Slide 27, costs. We are a cheap date internally. So one other point I guess I would make here, as opposed to other ways we might gain exposure, obviously external managers would be quite a bit more expensive. ETFs, prices are dropping here, but I think kind of unlike equity index funds, there are some technical issues with bond ETFs. They can't own the entire universe the way that we can, that equity does, so it's more of a statistical modeling of the characteristics that are in the index. And so they're oftentimes owning the big liquid issues, which may or may not be a good credit necessarily. To kind of get to those metrics, they typically underperform the index. If you look at kind of their history of returns, they can invest in derivatives. So that is an area where we may not be as comfortable, particularly at certain times if the market becomes stressed. So there's a number of issues there, despite that being a somewhat lower cost way to access the market. It's not something I would recommend, I guess, at this point in time. And with that, I will just kind of wrap up the slide deck portion here with internal fixed income. I think has been very successful over the years. Before my tenure here, we've had good returns at low cost with appropriate risk management, and I think that it continues to be a core competency of MBLI. So now we're going to throw up some stuff on the screen here, and we'll walk through some stuff. Get the computer set up for us.
Jack, sorry, my big fat head's gonna block you, but on the upside, you won't have to look at my face.
On the upside, it's a little nice, and it might be nap time. So we're going to run through a bunch of stuff on Bloomberg here. I'm going to kind of start with the bullet points that I put in the quarterly board report every go around, so that you kind of understand what I'm looking at and ask questions about that. And if there's anything that you see as we go through any of this stuff that you want to see in the board reports going forward or something, I'm happy to do that. It's easy to grab stuff out of Bloomberg and whatnot and put it in there, so just let us know. John's going to put up here is the yield curve. So I always make some comments about the yield curve, where are treasury rates, and what's been going on there. Sorry. So obviously it's a key area in determining our overall returns. And it's just kind of a graphic representation of rates. Yeah. Not that one. C15. All right, so here's the yield curve that we're seeing currently. So I'm putting in this is, let's see, the top one here is the beginning of the year, and here's where we're at now. So we can see rates have come down a little bit over time throughout the course of this year. And you've heard me talk over the last year about kind of the yield curve being pretty flat. It's not terribly evident here, although you can kind of see how we got a little bit of a kink in the curve, but if he goes back to the beginning of 2018, this is kind of the 2018 curve here, at the beginning of the year, and that would be a more typical yield curve, kind of an upward sloping yield curve. So you can see over the course of the last year and a half, we've had this big flattening where the Fed continued to raise short-term interest rates, and the long end of the curve out here didn't really change all that much. So that's what I meant over the last several quarters about a flattening curve.
John, wasn't there an inversion actually at one point?
There was, and there still is to some degree. So you can see what that's like the 1 year right there.
Do you
So
see
yeah,
that?
so you can see it best here. John pulled up. I guess that's, yeah, well, here's the current anyways. So, we're inverted right here from the 6 month out to really out to almost, well, probably about the 10 from the 6 month.
How serious do you think that is?
Well, so kind of the traditional recession indicator, if you believe it, is kind of the inversion from the 3 month to the 10 year. So we're not quite there yet. We were kind of briefly, maybe a few months ago. I don't know that it's gospel by any means. We've seen it, you see it happen throughout history. It happens from time to time, and it doesn't necessarily trigger a recession. I think just more generically, the flattening of the curve and what we've seen happen here and the slight inversion we've got in the front end, I mean, it's a good indicator that the market is nervous, that we're towards the end of the cycle. People are starting to think about when the next recession is, and people are starting to predict that, whether it's 2019 or 2020 or 2021. Who knows? We could go, a long time with this sort of a curve, but I do think it's an indication that we're kind of later innings in the economic cycle, and people have an awareness of that. And so it's helpful. Another place we might look for, an indication of what the market thinks about interest rates going forward is the interest rate probability screen. So this is the Fed Fund futures market, and it's what the market's saying about where they think rates are going in the future. So if I kind of look at kind of the December time frame here, currently the market's saying that by the end of this year, there's a 66% chance that the Federal Reserve is going to cut interest rates at least once. So here's where we're at right now. Fed funds is between 2.25 and 2.5. So they're saying that there's like 43% chance that we get at least one cut, and there's another 19% that we get two, and then very small probability that we get more than that. So they're assigning a pretty strong probability to the idea that we're going to get a cut in interest rates here. And a lot of this has been kind of more recent. We can see here the probability of a cut. It jumped in February, and we kind of started to see the tariff, noise come in, a lot of the political stuff that we've seen, and so uncertainty that we're going to get a deal with China and all of that has kind of entered the mindset, and that might cause us to have some growth issues, and that the Fed is going to have to cut rates in order to sort of offset that.
Is the they here Bloomberg?
Yeah, so Bloomberg is scrubbing, actual Fed Fund futures trades that are out there and compiling that for us to give us these probabilities.
So those trades are available to be scrubbed, so you can actually nail that down.
Right. Yeah. So next place.
How regularly do those change? Do they do them on a daily, a weekly, a monthly?
Yeah, it's changing daily. Yes. So the other place we might look if we're thinking about rates is the Fed screen. So this kind of tells us all kinds of things, anything you wanted to know about the Federal Reserve, what the current Fed rate is, the minutes, the policy decisions, all that type of stuff. But John's going to pull up the dot plots here. So I think maybe we've talked about the dot plots a few times before. This is what the Federal Reserve staff puts out kind of at their quarterly meeting. So the last one we got was in March. And the line that you're seeing here, this green line, so this is what the Federal Reserve board members believe that the rate should be going forward. Now this was their expectation, their median expectation, I should say, at the March meeting. That's the last time we got an update here. So currently, for 2019, they're kind of spot on with where we're currently at. They're basically saying, we don't think we need to change rates. The market, as I mentioned, they're saying, no, you're going to have to cut rates at least once. So their expectation diverges a little bit there. And it diverges even more as we get into 2020, where the Fed is still saying, median expectation is that we're going to raise rates another quarter of a point. And the market's saying, no, we think you're going to have to cut rates even further in 2020. So there's a pretty good divergence at the moment between what the market thinks and what the Fed thinks. But again, the Fed hasn't updated this for a little bit. Things have certainly changed since the March meeting, so maybe when we get to the June meeting, maybe we'll see some of those shift around a little bit. Next thing we'll look at is the break-even inflation rate. So I usually make some comments on inflation. So break-even inflation, as you might recall, is when we're looking at the TIPS market, so the Treasury inflation protected securities, and the nominal market. The break-even inflation rate says, so currently it's 1.84% for the 10-year TIPS. So we're saying if our expectation is that inflation over the next 10 years is going to be 1.84%, we would be indifferent to owning the nominal Treasury or owning the TIPS. So if we thought that inflation was going to increase and be, say, closer to 2%, we would want to buy TIPS. If we think inflation is going to fall, something lower, we don't want to own TIPS, we want to sell TIPS. So it's kind of, again, kind of similar to other metrics where it's just an indication of the market sentiment at any given point in time of what the inflation expectations are out there. You can kind of see here in December, maybe John goes back to the 1 year, probably a little easier. So as we entered kind of fourth quarter, when we saw a lot of turmoil, you can see inflation expectations dropped off significantly as there were more significant growth concerns over that time frame. And I'll kind of show you corporate spreads, similar type of inverse pattern there, I guess, as we go through some of that. So we look at corporate spreads. Again, as John said, corporate spreads, corporates are kind of the easiest because they tend to move the most. But I sometimes talk about agency spreads and mortgage spreads, similar things, but corporates are going to move the most. We tend to see here, well, you can see fourth quarter. So fourth quarter, market started getting nervous, spreads started to widen, so they've got growth concerns. They think that corporates might run into some headwinds, maybe they're going to have greater defaults over a longer period of time, whatever it may be. So spreads start to widen. And so we kind of looked at this last year. We started putting a little bit of money in December. It was a little bit difficult to get some money to work, but sometime in here we put about $25 million to work. And then we were hoping that it would kind of keep going and we'd kind of keep trickling some money in. We got to January, suddenly everything was fine again and snapped right back, and we can see pretty steep slide back down to where we were before, which at about sub 80, that's back pretty close to the tights. So kind of in late April, we started selling a little bit. We took about 20 million back off the table there because we just don't think we're getting paid as well for the risk at that point in time. But I'm usually making comments about whether spreads are widening or tightening at any given point in time. So then another metric I usually talk about is just kind of the health of the overall market. So we'll look at the league tables. So the league tables are, this is the new issuance market. So we see over here all the different broker dealers and the deals that they've brought to market. And kind of most importantly down here is as the total amount of new issue that we've seen over the course of the year. So we're sitting a little over $500 billion that's been issued into the market. Our total issuance for the year, this year as compared to last, we're down by about 8%. That's not a huge piece, and I would say that's been driven a lot by the financials have kind of built their capital ratios, and so they're at a place where they don't need to issue quite as much debt as they did prior years, so that's probably the majority of the differential there. Generally, I would say, healthy new issuance market. We've seen, plenty of people coming into the market. Yeah.
Is this just the U.S.?
This is just, this is just U.S. investment grade corporate. So you can look at other metrics here as well, but I should really say, dollar denominated. So it could be foreign companies but issuing in dollars in our market.
So if you looked at total issuance of debt in the world at any time, would we be like 50% or?
I don't know off the top of my head. If John goes back one screen, might be able to see that quickly. So, there's European bonds, I guess. Sorry, Terry, I'm sure it's in here somewhere.
I'm just wondering, our equity is about roughly 50% of the world's equities, right?
Yeah.
So I was wondering if the bond market was the same. Is that right?
Just looking at these top ones, I think that's, I don't know.
I think it's all of us.
I think it's more weighted towards international from the look of it, because, this is denominated in euros. We got 855 billion in euros. We got another trillion or so in emerging market bonds, so I haven't really looked at that before, but it looks like we would be a smaller piece overall. The last thing I might show here would be the trace amount here. So I think I talk about trace a little bit each time. So trace is the secondary market. So the trades that are happening in the secondary market, whenever a trade happens, broker dealers have to report that trade to trace. That's what we see, and we'll show later when we're looking at individual bonds. We can see, what level did that bond trade at, and so this is just a summation of how much did we see trade on any given. I think this is on a weekly basis actually, but and you can see that it kind of goes up and down. Generally speaking, average here is kind of 18.7 billion on a given day. Sitting at 15, it's still pretty healthy. You can see the big drop that we had here in December. So part of that, I would say, we kind of started to get a little bit of liquidity constraint in early December as people started to get nervous. They kind of pulled back from the market. There wasn't necessarily as much being traded here. This second drop here really is more the holiday season. So obviously everything dries up. If we looked at any given year, you'd see similar things. So this one here is Thanksgiving pretty much. So you see those kind of seasonal spikes. But it is a good indication of whether or not there's people out in the market trading. We kind of see that to some degree other places as well, but it's helpful. So any questions on that portion? If not, I will turn it over to John.
I do have questions.
Sure.
This technology, it looks like it's great. Is it? Do we need something more? Is this enough?
Bloomberg's great. Bloomberg is a flood of information, so yeah, we don't. It's the standard for the fixed income world. You gotta have a Bloomberg on your desk to do.
Is that all? You're saying that's all?
I wouldn't say it's all we need. There's other tools that we have as well for credit research and some things like that. But as far as the basic trading platform and a lot of this kind of high-level economic information, yeah, it's pretty much all we need. Yeah.
So John showed you what we're thinking about in the overall market on a daily basis. Also, on a daily basis, we're looking at every one of our portfolios. In this case, we're showing you the trust fund investment pool, more specifically the trust fund bond pool. So this shows you what we own in internally managed investment grade in the trust funds. It doesn't show you the high yield and real estate managers. So a couple of things that we're looking at here is our portfolio versus the benchmark in terms of percentage weight, and noting some of the differences. So a couple of the things that you'll note is we are significantly higher than the benchmark in terms of corporate industrials and financials, not so much in utilities because we don't like the dynamics of the industry there. But so you might ask yourself, well, wait a second, that's more risk, and didn't John say that we tried to manage risk and stay away from defaults? And so, yes, we do. There's a couple of ways that we do that. One is, as you'll note, the
duration of the financials and industrials. And in this case, we're going to use spread duration and interest rate duration interchangeably. You'll note that our duration is significantly lower, and so that we will be less sensitive to changes, and particularly spread widening than the corporates in the index. A couple of other things that you'll note that we're looking at, particularly in the context of the trust fund, is the yield. And so we would like to yield more than the index and do by a very small amount. And of course, we want to do that because that's what the clients eat. That's what they have to spend, and all other things equal, we'll want to maintain that yield advantage. But to do that, again, we have to take on that a little bit more risk in terms of financials and industrials. There are other ways that we can kind of tamp down that risk. And so if John brings up the portfolio by credit level, you'll note that we are overweight triple Bs. Terry pointed that out. But a couple of things you'll note is that we are significantly underweight the lowest level of triple B, the lowest level of investment grade. And so hoping to miss the major hit to market value should something fall from investment grade to high yield. And you'll also note that of the triple Bs, we're significantly short duration from the index, and that also limits your risk of loss there. So any questions on how we on a daily basis look at our portfolio?
So automation is going to take over your job.
Like everybody else's. Somebody's got to come in and drink the coffee, Jack. Yeah, so it is interesting how much more automated even we have gotten, even in just the past couple of years. I don't know, Kirsten maybe talks to a broker a couple of times a day. I probably don't. I am a broker maybe a couple of times a day. Maybe talk to a broker once a week. It used to be that you'd spend hours on the phone with the broker. And, you know, it's kind of unfortunate. Sometimes you miss the contact, but it is a significant time savings.
Is the cost of trading gone down commensurate with the improvement in technology?
I personally think that. I haven't run the numbers, Jim, but you know, John's going to show you market access and the bid-ask spread, the difference between what the broker buys it and what the broker sells it to us. We have seen that contract significantly. So theoretically, I would say yes, but I haven't the numbers in my pocket. No other questions? I will turn it over to Kirsten.
Great, so we talked about the economy and the portfolios. Now we're going to talk about specific companies and securities even. Mentioned earlier, we have an approved list when I added Starbucks to John's. You know, sometimes, why do we have it? You might want to ask, maybe. There's about 700 parent corporate companies in the ag, and there are 3 of us, so we cover about 110 on our approved list. And that means we follow the names, do credit analysis. In this example, I picked Anheuser-Busch InBev. I might just call it Bud. It's a little easier to say. That's the US ticker here. So here is an example of our credit matrix. I believe we showed you this maybe last year or so when it was a little newer. I'll start out by saying what is AB InBev. It's the world's largest beer company, so I'm trying to pick a fun one for you, just like Starbucks. They own almost 500 different brands of beer, ranging from domestic favorites like Budweiser to craft beers, and also a lot of international brands. Being a large global company that likes to participate in a lot of M&A, they have a lot of debt, which makes them perfect for our approved list. Okay, maybe not. A lot of debt means a lot of leverage. So if we scroll down to the bottom here, you'll see they've actually fallen to a 0 score on our credit matrix. That's right here. Did this at the end of last month, updated it. A 0, well, that's still approved, still a company we would buy as long as we're getting paid for it. As long as the spread is there to compensate us for the risk. I will say if it falls below 0, we take them off the approved list, which only makes sense here. And you might wonder where, all of our metrics come from here. So John's going to pull up in Bloomberg our financial analysis, and we actually pull a lot of these numbers straight into that spreadsheet we were at for the analysis, but it's nice to know we don't have to calculate the ratios ourselves or anything like that. It's available on Bloomberg for us. First thing I'll point out here is the leverage ratio here. It's over 5. That's more in line with below investment grade credit. But I will point out back in 2016 it was 7.5, which is actually getting closer to private equity. This is when AbbVie and SAB Miller combined, so there was a lot of debt put on them. They did fall below investment grade by the ratings even back then, and as you can see, they are deleveraging as they go. So another thing I would point out is the free cash flow here. They, they almost doubled it doing that merger. So in a way, that was a good thing for them, that their free cash flow is very high. One of the reasons that they're still on the approved list is they have the free cash flow to kind of sustain this leverage. Another thing management did in this last quarter was cut the dividend, which you don't hear companies doing that very often because shareholders don't like it. So they did that so that they are able to delever. And that shows, again, management's commitment to investment grade ratings. So all of that is incorporated into our credit matrix, and also the rating agencies see the same things.
Yeah, Kristen, is your matrix different than everybody else's? I mean, do you use different components of that, or is that a standard matrix from Bloomberg that everybody uses?
It is ours. It's something that has gone through a few different iterations through the past 2 years or so. When I started, the approved list wasn't as solid as it is now. We didn't have anything like the matrix where we were keeping track of how we felt about the companies or things like that. John and John might be able to expand upon that a little bit, but this was really to help me when I started, because I wasn't a credit analyst, and this made a lot more sense to me to keep track of everything and understand where the metrics come from.
It was a lot of, John and I have been doing this for years, and we had our process, and we had a lot of that stuff. So we kind of went out to some of our external managers that have things like this, and we borrowed some of their ideas and things, and came up with our own format, because we realized that we were, it wasn't very fair to Kirsten to not have something a little more ironclad, I guess, that we can follow, and it's helpful to all of us to kind of make sure that we're going through that process. And, we've just been doing it a long time, so we maybe didn't feel as beholden to something like that, but but pretty quickly realized that, yeah, we should be doing it too. It kind of keeps us all honest is what it does, really.
If zero's just below zero, you're gonna drop it. What's the top range?
10.
So what would be a 10 company?
I think the closest name I've covered is Microsoft. And that makes sense, they're rated AAA by the companies, and I want to say they came out to an 8 when I did it last, so I haven't seen a 10.
We kind of roughly think of it in terms of like a 0 is a triple B minus and a 10 is a triple A. Now, it doesn't always work out that way, but that, you know, there's kind of 10 steps within the investment grade universe, and so, you know, it gives us a framework to say, this is a low quality credit in our view, or it's a high quality. And you can see with like App InBev, you know, Kirsten's got a 0 on it. Well, the rating agencies still have a triple B plus A minus on it. So they're, you know, that should come out to more like a 3-4. Now there's reasons why, as she's explained, that it's there now. I think our expectation is it probably goes back up over time if they do what they're telling us and they delever. So it probably gets back to where we feel, yes, that's commensurate with kind of the rating agencies, but we're not sure it's there now. And
So of your corporate, what percent would you say are zeros that you're currently investing in?
Oh, so we don't own any Abbott.
Oh, you're just looking at it.
Right, well,
we did own it. We actually sold it after she did this analysis.
Oh, yeah. Right.
So that kind of led to the question I had. If, you know, it was a huge company, obviously, been around for a very long time. I could see where maybe it would stay on the list and you'd be wary. Are there others that would have that 0 rating where you just say, yeah, I don't think so, no matter what? Absolutely.
Yeah.
And
And we'd probably take them off the list.
so really, that's part of the purpose of your analysis, not just to see what somebody else rates them at, but it's your, what would I say, your comfortableness with a particular entity and how long they've been around and how they operate. So you don't have to be negative to be off. You don't.
A good example,
Good
I
answer.
have McKesson Healthcare Pharmacy name. They had a lot of trouble due to opioids, and the headline risk was so high with them, and they were trading very tight. And I said, you know, it's not worth it if that turns into a big tobacco settlement down the road. It's not worth it for them. So we took them off the list. They were rated credit-wise pretty high. All right, let's see. Another kind of like having an additional analyst is credit sites. So they listen, they're analysts, they listen to all the earnings calls, so we don't have to, and write about it. So this saves us a lot of time here. They have tear sheets that, you know, give us just a breakdown of the company and kind of the FA type stuff we looked at here. They also give M&A updates. And then one of my favorite parts is the analyst's information is always attached to all of the pieces they write. So if you have a specific question, you can email or call them and get answers to your question, and they've always been very helpful. So this is kind of like having a team of analysts behind the 3 of us here for our program. Really nice.
Question. Are there competitors to credit sites?
So we have one other, Give Me Credit is what it's called. We also subscribe to them. They don't have quite as many names and they don't write as many updates, but that's really, those in the rating agencies are really the only companies we've found so far that do the real credit analysis. We talked about companies. Now what if we wanted to look at a specific security? We're going to stick with the Abb InBev here. This is our fixed income worksheet. We've pulled up the largest issues of Abb InBev and charted them. Looks kind of like a yield curve here for you. And I'm just going to use the example I'll say John came to me and said, I need something around a 10-year corporate for trust fund. Do you have anything you like? And I might take a look at Anheuser-Busch, since we don't own any, we have lots of room in it, and see, can pull up the description page of what's almost a 10-year here, it's about a 9-year. And the description page is nice, it gives you this amount outstanding, so we know it's a huge issue, 2.5 billion. We can see when it came out just last year, that it's, you know, US dollars, if there's a call on it. So this is good just to make sure there's nothing weird about it. It's benchmark size, so it'd be a little more liquid. And then another screen we look at is the yield and spread screen here. And this is great when we're looking at pricing for security. And so John was talking earlier about TRACE. Well, it gives us the TRACE just for the security right here. So secondary trading will be up here. Down below here, this scrubs all of the messages that we get, and we get a lot of messages on Bloomberg, and shows kind of where brokers that might have them or be selling them at what price down here. And then we can also see the price, the yield for these bonds. We're looking at it. So, you know, Bloomberg is saying it's, you know, probably around a 127 spread. Most likely, I'd say still not good enough for this issue. You know, we bought Starbucks a little over 100 a couple weeks ago. For half the low rating, we give it a 0. Still wouldn't be a buyer at this point. Are there any questions on specific security analysis in Bloomberg?
What's Starbucks under rating?
Do you want to pull it up?
BAA1 triple B plus, right?
Yeah.
But on your...
On our rating, it's a 5, which is very high compared to, yeah.
Considering that it's a triple B, so kind of going by that scale, we'd say triple B, it should be like a 3.
Yeah.
So at 5, we think it's probably more of a mid-single A. It's pretty good.
Yeah. Great, well, I will hand it back to John.
So we were talking a little bit more earlier about the electronic exchanges and things that have come, being a little more prevalent here recently. So I know we've showed you in the past, Bloomberg AIM is our trade order management system, so everything we do runs through there. So when John showed kind of port, our analysis of the portfolios, all the positions and things are logged into Bloomberg, so when we're pulling something up, it's kind of cross-referencing that and making sure that, hey, we own that security and we can trade that. So we'll take a look at the Starbucks securities here. John mentioned that, you know, we got 55 million, let's say we want to sell a little bit of that. So first thing we do, you know, let's say we're going to sell 5 million out of MU8G, our corporate portfolio. So John fat fingers something and puts in 50 million rather than 5 million. Kind of put that up there and says, no, short position, not allowed, you don't own 50 million. Those are all the compliance things that Tim and Mike have weighted into the system, so it kind of prevents us from fat fingering something and doing something bad. So we change that to 5 million, we go up to the top, we check compliance, and we do this for every trade that we do. It doesn't matter, you know, where we're doing it at. From there, we can send it to the desk. So the desk is me, John, and Kirsten. We don't actually have other traders like some, I guess, organizations would. Nice thing about this is that if I'm trying to do something, I stage it up, I got a meeting, I can walk into either their offices and say, hey, could you grab that and do that trade? Here's what I'm thinking about, and they can kind of take it from there. So we can do this, you know, either within Bloomberg and talk to brokers directly, which would have been kind of more traditionally what we would have done. John mentioned market access, something we signed up for about 9 months ago. So he's going to send it to the liquidity platform. It's called Market Access is the liquidity platform. So we got the order here, it's staged in Bloomberg, we know we're good as far as what we own. We're gonna go out and try to sell 5 million into the market. We click on, over here to the right, John's got, click the broker button. So everyone that we have a direct relationship with will get a notification as soon as we send this out that, hey, we're thinking about selling this particular thing on the market access platform. So they'll see it, and he's gonna go ahead and send it there. So the two systems are tied together. Market access is separate from Bloomberg, but they talk to each other. So he sent that order over. We see it up here at the top, so here's the Starbucks order that he just sent. We can go into that, then pull it up. We're going to open an inquiry, and that's going to allow us to get to a spot where we can, look at that and actually send this out to the market. And so if we look at this, so there's a few things here. So we usually kind of do like one-step pricing, which basically allows us to, it'll immediately spot the treasury as soon as we agree to a particular level. We send it to the bin typically, so that just allows us to pick, how much time do we want to give the market to react to this particular order that we're going to be out there. Most of the time it's 10 minutes for a basic corporate like this. So kind of most importantly, over here, we'll typically select all. So when we do that, we see a whole bunch of dots here that came up yellow. So those are all the brokers we have a direct relationship with. But in addition, we see a whole lot that are gray here. So those are a bunch of other brokers that we don't have a direct relationship with, but they're on the market access platform. So they can trade with us, and market access will act as the broker-dealer. So they will charge us like less than a bit typically to do that trade for us, similar to what another broker would do. It's kind of a crossing type trade. So that gives us access to a whole bunch of people here, obviously, that we don't have a direct relationship with. In addition to that, anybody else that's on the platform is going to see that. So if CalSTRS is out there, or State of Arizona, or whoever it may be, we may be trading with another pension fund or another asset manager that's out there that's not really a broker-dealer, but market access acts as that intermediary for us. Again, which is kind of part of what I think over time has helped compress that bid-ask spread, because at that point, you're kind of cutting the broker-dealers out of the relationship potentially. And so they're going to get a little more aggressive, and they're up against a lot more competition. Typically, how we would have done this in the past would be, we would have, over Bloomberg, get into the chat. If I wanted to sell some Starbucks, I might have approached 4 or 5, maybe 6 dealers in the chat and said, give me your best price on this. That's about as much as I can handle in the chat. I can't go out to 50 different people. It's just no way. So it's been really an effective tool for us, and we've used it, I think, a lot more than we even expected that we would. So it's been pretty helpful. So we're not going to actually send this one out, but we'll take a look at this Diageo one. So this morning, I went out. So Diageo, keeping with the theme of food and beverage, we had a couple million that's in MUHG. It's on, we were looking at the yield curve earlier. It's kind of a 3-year security, so it's that dip, that low dip in the treasury curve, so it's not a real attractive point on the curve. It's trading really tight. Thought about lightening up on this and selling it. Looked at the trace screens and the FIW screen that Kirsten was showing you earlier. It looked like it traded a little below the curve. We saw some good trace prints out there, so we felt like we knew, where it should trade. Put that one out to the market, and you can see here that we got 10 bids on this particular security, so probably twice as much as I could have gone if I tried to do it over chat. So when we get that, at the end of that 10 minutes, we kind of get the pop-up. Yes, sir.
So, John, essentially, I think what I'm hearing you saying several times here is that because of that last feature where, you get, instead of 4 or 5 people that you have to talk to on the phone over a period of time,
right,
you hit a button.
Yep.
You've got more time to think about what it is and talk about what it is you're going to do rather than the execution part.
And we're also putting a lot more people in competition with each other.
Yeah.
So
So on both sides, you got more time to think about what you're going to do.
Yeah.
and that you get more competition when you execute,
Right.
we're benefiting on both sides.
Yeah. Yeah.
So you
Yeah,
can
the
see-
time saving has been huge.
Oh, yes.
For sure.
So you can see with this one, so I didn't actually like the bids that we got back this morning. So when I was looking at Trace, I thought they should have traded probably 48 basis points, maybe a little tighter, I was hoping. Best bid I got back was a little under 51. Didn't think that was a good enough bid, so we don't have to hit it. You know, we put it out there, didn't like it. I passed, as you can kind of see in the status here. But we got 10 bids, and out of the 10 bids, I got 4 from people that I have a direct relationship from, and I got 6 others from market access people. I don't know who they are specifically, but I got bids, and actually 2 of the market access bids were better than any of my direct relationships. And I'd say that's, you know, I'd say probably 50% of the time, we're probably hitting somebody from market access who's kind of anonymous to us, as opposed to hitting somebody who we have a direct relationship with. So it does cause everybody to kind of step up their game. And as you're sitting here, when you kind of get all these bids back, if I'd wanted, if somebody had say bid 49, and I really thought it was worth 48, I could have countered, and I could have sent them back and said, I'll sell it to you at 48, and then they could have decided if they wanted to hit that. So we can still kind of continue to negotiate here if we want to. They were far enough away that I just pretty much knew they're probably not gonna hit that. But you know, it's also, it is a way for us in kind of a dispassionate way sometimes to sit back and say, well, here's the level that we expect. If we're not getting there, we're generally not, you know, we're not in a rush. It's not something I had to do. We're not a forced seller. I don't need to raise cash necessarily. It just looked like a good opportunity. So, you know, we really do kind of get to sit back and decide. That's helpful. So on the flip side of that, we can go out and buy on this platform, which has also been very helpful because, as I mentioned during December, when we kind of put a little bit of money to work in the corporate market, we weren't seeing a whole lot out there from a lot of our broker dealers. They don't tend to carry inventory anymore. So we can see everything that's happening out in the market. And so these ones, well, there's some live ones here now. So any of these ones that are saying kind of do app, and they say live right here, all these are live things that we could go out and execute a trade currently. Now we do the same process. We'd go into Bloomberg, we'd stage a trade, we'd send it to the platform, and we can look and see. So if somebody's offering, what do we got? 2.236 million at Caterpillar, let's say, we wanted that, we could go out, we create that ticket in Bloomberg, we send it to the platform, and it immediately sees that there's a match. And so it pops that up, and then we can submit a bid. So we can then buy that security off of there if we were the best bid at that point in time. So that was really pretty helpful to us, I think, in December, because I'm not sure we would have even been able to put all that 25 million to work because the broker dealers don't typically have that much inventory. I think what you see a lot of times in here, you see a fair amount of trading in the morning, so I think a lot of it is kind of the ETFs and the asset managers adjusting their portfolios, and you know, some of it's very small size, so it may not be appropriate. You know, it's like 100,000 or something. We're not generally going to play there, but there's pretty decent sized blocks in there a lot of times. You know, multi-million-dollar blocks that are sufficient for what we need. And it also gives us an opportunity at times to just build a position. Trying to think, Amazon, I guess, was the one that we had a while ago where we could never really find the paper. We wanted to buy some Amazon, and so we started buying on market access, which is kind of buy a million at a time, and we were able to build a decent sized position over a week or two, and kind of just in bits and pieces. And so that's kind of helpful as well. Trying to think what else. I think that's about all we have for this section, so happy to answer any additional questions. If not, we'll send you on to the next item on the agenda. Thank you.
John?
We just, so like, yeah. We've gotten a lot back over there. I'm 1 million. Bigger amount.
Now, I'm glad to hear about your efficiencies and all these extra tools you have.
I didn't talk about it. Not getting my other FTE. I thought about it.
I held it in a bag.
He's the executive director on the bus.
I don't believe you.
No. So you guys are in trouble now, I've got the gap.
Oh, let's roll.
I'm thinking about a break, no. So Doug, you're up.
Okay, thank you. He's, well, now it's.
Good afternoon, Mr. Chairman, members of the board. I'm on tab 4. I'll give you the commercial and residential loan portfolio. As of April of this year, the portfolio had $169,618,524, and that's 109 individual loans or participations. Since our last meeting, I funded 7 IRP loans totaling a little over $190,000 and 3 participation loans at $1,269,352. We currently have 3 reservations that total $12.2 million and 6 loans that we committed to. That's a little over $39 million. The biggest one of those is the Springs of Bozeman, which is $28 million. The commercial loan portfolio, excluding the Veterans Home Loan Mortgage Program and Science and Technology, is a yield of 3.07%. Any questions on the participation side? We still have the one property in Great Falls that we're trying to sell, which is the on the border property. The property was scheduled to close on May 15th. The seller asked for an extension of that time period to give her more time to complete the liquor license transfer. So we agreed, along with the participating bank, which is First Interstate Bank, to go another month. So the scheduled closing time of this date is June 14th. So we're hopeful that the liquor license transfer will be finished by then and it'll close up for us. The intermediary relending program portfolio currently has a balance of a little under $4 million, and that's 32 loans. There's 5 loans that have funds available for new advances that total $625,786, and there's one committed loan of $187,500. The portfolio has a yield of 2%, that's under statute. There's no past due loans. And as we discussed in loan committee, the legislature did increase the allocation from $5 to $10 million in that program. The residential loan portfolio has a balance of $3,959,486, and that's 97 loans. The yield is at 6.61. There is one loan over 90 days past due, so it represents 1.2% of the portfolio. The property securing that loan was acquired at a trustee sale on May 1st. So the Board of Housing is in the process of filing a claim with FHA to pay off that loan. So we'll essentially get paid all of our interest except 60 days, and then we'll be reimbursed for 2/3 of the foreclosure costs. So that should happen within the next 60 to 90 days.
Question,
Yeah.
I wonder if those are correct numbers, because your loan portfolio balances are the exact same on the intermediary intermediary lending program as they are in the residential loan portfolio. They're both 3.959.
That's interesting. I'll have to take a look and I'll let you know, but that would be quite a coincidence that they're both exactly the same. I'll check that out. Thanks for pointing that out. The Veterans Home Loan portfolio reflected a balance as of April of $38,263,798, and that's 225 loans. There's 2 reservations, 487,107. The portfolio has a yield of 1.88%. There was 1 loan over 90 days past due, amounting to $176,377, which is 0.46% of the portfolio. So very low past due percentage for the portfolio. And then the 2019 legislature did increase the allocation from 40 million to 50 million in that program, and that's effective on July 1st, that will increase. Yes.
Back for a moment to the, on the border property. We wrote that off, didn't we? Totally.
Which, the,
on
the border?
Property.
No, we've written it down to the 670,418.
Do you want to touch on the affordable housing?
Yeah, another bill that passed the legislature was, it's yet to be named what the program is going to be named, but we call it the Affordable Housing Program. And there's $15 million set aside for low to moderate income housing projects. And the Board of Housing will be administering that program for us. So it'll act just like the Veterans Home Loan Mortgage Program. We'll probably be involved in the administrative approval process with the Board of Housing, but it'll be their process, their policies, their rules. We'll just end up purchasing the loans when they request the purchase to occur.
We'll probably try to interject ourselves into that process if not invited. There are some pretty unique things about that bill, a 95% loan to value, so it's very heavily leveraged. So the folks that are going to qualify are going to typically be high net worth individuals, and we'll have to go look beyond them for collateral, or beyond the actual property for collateral, so.
Yeah, and it's another program where the legislature is dictating the return on that program. It's a 0.5% below the Board of Housing's market rate, and I'm not sure what the Board of Housing market rate is at this point, but that's where we'll be at.
Did you say high income or do you mean low income?
The people who will build the property will be high income. The people who will reside in the properties will be low income. But it'll be hard to qualify, at least for us. Here, 95% of it is state money. You've got to be able to capture that, be able to insure it, and we can collect it if need be.
Can it be a nonprofit?
It can be a nonprofit, but I don't think the nonprofits are going to participate because they removed the tax exemption for a participating nonprofit.
Nonprofits don't pay taxes on it.
But they will have to be required to pay taxes on any properties under this program.
Okay.
So, Doug, your concern is the legislature's building something into our loan portfolio that we know we're not going to get the kind of return on investment that we would get if we can invest the money somehow.
That's correct.
Yeah. So when they come back to us and say, how come your portfolio isn't performing, when they build things in that aren't going to perform the way we can make, you all can make them perform, you need to look in the mirror.
Does that money come from the coal trust?
Yes.
Seems to me that you have to meet underwriting requirements for the loans.
That's correct.
And not to be technical, but another collateral may not work in a home loan, because if you finance it with a trust indenture, you have no, it's not recourse. I mean, against the property.
It's a weird
It's
program.
problems, you know.
It's going to be difficult to administer. One thing that we've talked about is exactly Bruce's point internally of, as the legislature continues to choose winners and losers within the trust fund, it's not our business to say this bill is good or this bill is bad. If they want to designate certain portions of the coal trust for these purposes, fine, but it shouldn't be a knock against our returns, that we're able to accurately segregate them out so that as additional programs come into creation, or, I mean, Veterans Home Loan Program, let's just be clear, that number's going to keep going up until they decide not to increase it anymore, because who's going to go testify against the bill? So, at 1.88%, you just heard trust funds at 2.49.
As long as the accountability is where it should be, that's fine, but when the accountability ends up here, that's a problem.
Well, I would like to interject something there, then, if I may. I agree with you completely. I think that you run amok sometimes and do things that perhaps we don't look at the full picture. I would urge the board to find ways to interact more often without necessarily saying you can or can't do this, but to simply offer up the opportunity to understand what the consequences of what is being proposed. It would be very helpful to us.
Be a challenge is all. Seems to me.
Anything else? All right, thank you.
On program,
Mr. Chairman, the bond program activity is behind tab 5. And we've discussed the City of Billings and also the in-stage or the policy changes. So those are already approved. So I'll just go briefly over the activity and the staff approved ones. And if anybody has any questions, please feel free to speak up and I'll be glad to answer those. So for the activity summary, this is very familiar. This is our quarterly that we have. We have the comparison of what is fiscal year, as of the fiscal year, and also a 5-year span of a comparison. You'll see that fiscal year 19, we're a little bit lower. It's a little slower year for us this year, but we still have loans outstanding in the 80 million with commitments pending of almost 25 million. So we're right in there. Were there any questions on the activity summary?
Is the interest rate difference that's been going up, does that account for some of that loan activity?
I really don't think so. I think the slowdown in construction and the winter that we had, a lot of the projects were delayed. So there are some that, example with these loans, commitment pending, some of those are the interim financings that we have committed to, but those projects have been delayed because of a longer winter session. So we will probably see those pick up a little bit, but as it goes for a fiscal year, I think it's going to be much less fundings this year than it has in the past. Any other questions? Okay, moving on to staff approved loans. Of course, with the staff approved, we always have some really nice and fun ones. This small one for Pleasant Valley School out of Marion. This was a Suburban. This hauls all their kids. So it's not the typical bus. They were really excited because they had, I think, a 1980 something that was on its last leg, and we were able to upgrade them to a 1996 Super.
Ooh, wow.
Yeah, so they are flying high with that one. That next one there, this was one of the towns that we had a little difficulty with. You might remember, probably back in 2012. They were a little tight. Their city council, their town council has changed since. Their financials have totally turned around. And so with this one, that when they're purchasing a skid steer, I love those little machines. They are the best thing in the planet. And so I said, I'll tell you what, if you go default on this loan, I know how to drive it, I know how to load it, and I know how to use it.
You can use it to develop that lot over there.
Yes.
Really?
That's a lot of dirt work. I need my dump truck too for that. So the others, we have Bridger Canyon Fire District, we have Park County Rural Fire. Doug said, you know, if we ever have anything where a fire truck goes default, he knows how to drive them, so we're good, we're covered there, we've got to drive them. Stillwater County, they picked up a jet boat for their search and rescue. And I looked up that jet boat and it's pretty nice. It's nice. So I think Director Bill is hoping they'll go default, so we have something to do in the summer.
He can drive that, can he?
Right.
I'll learn if nothing else.
Well, it's been very nice. So that's the information for the quarter. Does anyone have any questions for the bond program? Okay, seeing none, thank you. Oh, yes.
So you look at something like the Bridger Canyon Rural Fire District and that kind of loan, what is the interest rate on the loan?
Interest rate is for the intercap program, the interest rate is the same for everyone.
Okay.
So it's variable rate. This period, it changes every February. This time around was through the Q session. Right. Seeing none, that was all I have. Thank you.
Take about a 15-minute break till 3. We ready?
Yep.
Says you're quarterly review.
Great. Well, we're going to start off with a presentation that we handed out. Everyone should have one. We didn't hand it out in advance for reasons. We're going to essentially discuss some results for a survey that was sent out to all of the board members, and we didn't want to keep our hands, so that's the reason why we're going to send it in advance. But as you know, providing education at least twice a year, probably more, is something that is part of our mandate. And for this meeting, we have cognitive biases in investment decision making. It's a field that really has emerged and become more prominent over the past, I'd say 5 to 10 years. And it's kind of a lighter topic, but I assure you it is very important. And you'll see just from the survey, but just also as we go through some of the biases that are common in investment decision making. These are very real things that can impact decision making in a negative way, so being aware of it is pretty important. So we sent you a short, in terms of the agenda, if you go to page 2, I actually don't think there's a page number on the contents, but what we're going to do is just kind of general intro to what are cognitive biases. You also hear the term behavioral bias. Then we're going to go through the results of the little survey that we handed out. We only got 6 responses, so even if we got everybody to respond, it wasn't enough to be statistically significant. So we're actually going to share results from a conference that I just presented this at about a month ago, where we had 49 surveys returned, so it's a stronger sample set. Then we'll just go through some other cognitive biases that are common that we didn't necessarily test for, and some tips to manage these biases as you encounter them.
Are these results in Arabic numerals?
What's that?
Are these results in Arabic numerals?
What is that? I don't know if I get
It's a
that.
bias thing.
Okay. Sorry.
So are our results in here?
I'll mention them briefly. And you got some independent thinkers here, which is good. So the trends that you saw didn't necessarily apply to you, which is a good thing. But it's again, it's a small sample set. You can't really draw conclusions from 6 people.
Does that mean we all had the wrong answer?
No, you were independent. You'll see what I'm doing.
So your contract is coming up.
Yes, we're mindful of
In
that.
fairness, it was actually positive. You showed one bias.
Oh, that's a good one.
On one question, you were definitely showing bias. On two, you actually didn't, so.
Good recovery.
Well, I mean, the data's the data.
Well, because we're independent, that means to all of us, we're all right.
That's right. So, page 3 is just a definition of what is a cognitive bias. The key point here is they are ways of thinking that are not necessarily consistent or inconsistent with logic or rationality, and they're systemic. They're not random errors. They're ways that people think that in a lot of ways is not in their best interest to think that way, and they're systemic in that maybe not everybody experiences them, but a lot of people experience them, and they can be detected through measurements. If you turn to page 4, just a quick recap of what we actually did with the survey that had 3 questions on it. For each case study or survey, we basically had 2 different versions where you have, which some of you have experienced before in the orientation that we did at RVK. But we had 2 different versions that are essentially measuring a similar financial concept, but framing the question a different way. And you'll see, depending on the way the question was framed, it can materially impact the way you answer it. And we tried to do this with 3 common biases that you typically see. Some other biases that we'll discuss are a little harder to measure, but it's pretty revealing when you see the results of these case studies. Again, we had a small sample size here, which I will add to the general database. I haven't had time to do it yet, but the results that we'll share are largely based on the presentation that was given about a month ago, where we had a sample size that was sufficiently large to draw some conclusions off of. So, page 5. So, if you remember the second question, we essentially had 2 versions of the question where in the first version you were asked what was the 20-year return, well actually, what if the 20-year return of gold was less than 15%, yes or no, or less than 8%, yes or no. That's the anchor. What we're trying to measure is an issue called anchoring, which is if you get a number thrown in front of you, even if it's completely unrelated to what you're tasked to do in terms of providing an estimate, you're going to anchor to that, and that's going to affect your answer. So we tested this by, the anchor was the 8% or 15%, which didn't necessarily relate to what we were trying to measure. What we were trying to measure was, what is your estimate looking forward over 10 years for a 60-40 portfolio? You actually showed the opposite, believe it or not. Now, granted, this is a sample size of only 5. We actually, Mark, you didn't respond that last question. You responded to the first 2 questions, not the third one.
I didn't.
So, anyway, I'll show you. You might have missed it. So it's an N of 5, but you came out actually opposite of this. So Montana, for the 8% anchor, you estimated about 6.5%. For the 15% anchor, you answered 5.2%. Again, very small sample size, but when you looked at a large sample size, it actually was pretty strong. So the people that had the 8% anchor responded with a 10-year estimate for a 60-40 portfolio of 6.4%, and the 15% anchor responded with almost 8%. And what we try to do in this presentation too is, how does this play out in the real world? It plays out in a number of ways. One way that it's actually played out recently for a team that I work with, where we're looking at manager fees and trying to reduce those fees by doing some pretty creative performance-based fee structures, which are advantageous for a lot of reasons, one of which it enables you to get around MFNs that apply to fixed fees. And it was amazing to us when we started the process. We looked at, okay, what is the current fee? We look at the entire universe, what's the median? And starting from that as a starting point, when the reality is we learned over time you can get much lower than you ever imagined. And that's just one example where you're kind of anchored to, you look at the status quo, you look at their current fee, and you may leave money on the table by not pushing further than you think people are willing to go. I'm going to pause there. Okay. The second well, it's actually two effects that we looked at are, one, the endowment effect, and two, mental accounting. And this is actually, and it's consistent with your survey as well, the strongest effect that we saw. They're kind of confusing to explain, but essentially the endowment effect is the bias that if you own something, you value it at a much higher value than if you were to buy the same thing. I think an easy example of this is people who are willing to own a bottle of wine that they bought for $50 and could sell for $500 and still drink it, but it's hard to find somebody who would drink buy a $500 bottle of wine and drink it. And then mental accounting is the concept of, and this actually plays out a lot in the investment world. Mental accounting is the concept of people think of assets in different accounts and treat them separately rather than looking at a portfolio in its entirety. And the way we tested this is, it was actually the third question on your survey, where you were asked in two different ways questions that, in essence, you'd have to sacrifice $350 of your net worth in order to attend a concert. In the first situation, you bought a ticket for $100 and lost it, and you had to repurchase a ticket for $250, so it cost $350 to go. In the second situation, you bought a ticket for $100, you got robbed, you lost $250, you could recoup it by selling the ticket, or you could just go to the concert and, in effect, it would cost you $350 because you lost $250. And the results are pretty striking on this one. So in the broader survey, only 10% of the people would actually buy that ticket. And in the second survey, only 24% would actually sell the ticket, 76% would go. And the more striking thing is when we asked, well, what would it take to sell that ticket, because there's a price for everything, the price was $617 on average. And I'm sorry, that includes MBO, the Montana, that's the Montana Board of Investments, it was 500, a little over 500 for the large survey group. So this actually, you were very consistent, and in terms of how many people would let go of the ticket, 100% said they would not for the Montana group, and
we don't gotta get a lot of these.
And only 33% would buy the ticket. So there's a pretty striking difference here, and one way this plays out is with assets that no longer have attractive future prospects, but the mental accounting can work out, and you don't want to let it go until you kind of get back to even. Everyone's probably experienced that. So you think of it, in a separate account, you kind of want to get back to even before you let it go. And just the concept of when you have something, even if it's if it's done really well, but the future prospects aren't as attractive, you don't want to let it go. So this is something that plays out in investing a lot. One defense, we'll talk about it a little later, that we use is when you're reluctant to let something go, or you think something should be sold, but you're reluctant to sell it, fearing that it may bounce back. Just reversing the question and asking yourself if you would buy it at that price, or if you would buy it given what you know. And you'd be surprised how many times you ask yourself a question differently and literally answer it differently, even though you're the same person. The third thing we tested, and this is, when you look at a lot of the studies by Amos Tversky and Daniel Kahneman, you may have heard those names, we list some books at the end. Loss aversion is one of the strongest biases out there. Without getting into too much detail, simply put, if you look at the pain of a loss versus the pleasure of the equal gain, the pain of the loss is a lot more significant than the pleasure of a gain. And the way you test this is, it's actually a pretty simple example. Half of you had the choice of either losing $100 or rolling the dice and having a 50-50 chance of losing double that or losing nothing. And the other half had the opportunity to take $100 or roll the dice and have a 50-50 chance of either winning 200 or winning nothing. And what you would expect to see is people hate losses and they're willing to take a risk to avoid it. Now in this case, the expected value is the same in either way you do it. But you'll see a lot of situations where, and we'll do this test, for simplicity, we didn't, but they'll do a test where the odds are 55% chance, you have a 55% chance of losing $200, or you can lose 100 and people will still roll the dice. They will take risks that don't make sense in order to avoid a loss. And then on the flip side, you can have a bet where you're better off taking that risk, and if you do it repeatedly throughout your life, you're going to benefit, but people just want that immediate plan. So in either direction, it can skew your perception of when it's wise to take a risk or not. In the larger group, you saw exactly what you would expect. In the loss situation, more than 50% of participants wanted to roll the dice to avoid a certain loss, and then in the gain situation, only 1 out of 5, roughly, was willing to do it. Now, you came out even, so 33% in each case. So again, you're independent thinkers, at least for the people that return the survey, so that's a good thing. And then the real-world application for this is, and you see this a lot in institutional investors, especially in retail investors, is the excessive use of active managers in relatively efficient markets, or where people are not well equipped to succeed with active management. And the reason is they, want to take the risk to avoid just the certain, granted it's small, the certain loss of the fees that you would pay for passive management. Well, I pause there. That's a lot to go through. It's somewhat fun, but this stuff is actually very real. I want to pause there. Any questions about those, or we'll go into a couple more?
You cited the question here, you forgot to include the word favorite, which is why I spent the $500 for that. I wouldn't have another chance at that band,
I thought I'd answer it differently depending on point in my life, too.
Yeah.
Especially with concert things. Back with kids in school and in the house. There's no way you take that risk. So for me, the favorite band.
Then you'd expect on the flip side, you would expect people to, if they lost a ticket, to buy it for that amount too. And you don't see that. So it's pretty powerful effect. And I think the best defense against that one is just to reverse the question in your head. If you don't want to sell something, would you buy it? And you'd be surprised. I ask myself that. I personally ask myself that all the time. And a lot of times I answer no, I don't want to sell it, but no, I wouldn't buy it.
So do you sell it then?
Yeah. Well, I mean, you look at the data, and that's something we'll get to later on. Is the source of a lot of biases are driven by your emotion and just going by the data and allow the data to tell you what to do.
I remember answering all of them, that's not written it down.
Well, maybe we'll revise the numbers
Well,
after we do it.
I remember all the questions, so I didn't miss one. I mean, I didn't overlook one.
So those were some of the fun ones, and there are real-world applications for them. The ones that we didn't necessarily test for, but are a little more complex, and you actually do see a lot, are starting on page 9. Herd behavior is probably something that a lot of you have heard of. It's something that recurs time and time again in the investment profession. It's essentially the tendency to invest in things that are presently popular and everyone's doing, regardless of whether, first of all, whether it's attractive. Second of all, even if it is potentially attractive, whether it makes sense given your objectives and risk tolerance and constraints. The obvious examples here are asset bubbles. It happens all of the time. It will happen again. It happened recently with the cryptocurrencies in 2017. It happened with the residential real estate bubble. It happened with the .com stocks. It happened with railroads, tulips, you name it. These things happen time and time again. And some people have speculated the source of this is human nature. There's a benefit from following the herd. If there's one watering hole left on the savannah, you probably well, you don't want to be the last one there, but you probably benefit from following the herd there, but investing is the exact opposite. As more and more people pile into an investment, the price goes up, and if you're the last one in, look out below.
I don't know what cryptocurrency 2017.
Be happy that you don't. It's the Bitcoin, Ethereum, there are a bunch of them. And it ran up in 2017 where everybody was making a killing on I think it went from like 2,000 to 20,000 and fell back down to 3,000. Actually changed up again. It's essentially a form of...
You know what a whiskey chain is, like a chain letter?
Yeah. I don't know if it's that much of a pyramid scheme, but yeah.
You lose your whiskey.
Yeah. So those are the obvious. Some of the not so obvious are investing in asset classes that may not fit with your objectives. You see this with smaller plans that are getting into hedge funds and private equity when they're really not equipped to do it. Those are some of the not so obvious examples that really can get funds into trouble. The next page on page 10 is the optimism bias. And this essentially refers to the tendency for people to overestimate the strength of their abilities or the probability of desirable outcomes or low probability of undesirable outcomes. And it's something that you see common, it's something you see with asset managers in terms of their presumed skill in terms of selecting securities. It can play out in terms of actually, a way this plays out a lot, it's not something that you do, but it is something that you'll see plans get in trouble with, is tactical allocation. You go into a meeting and someone in the meeting says, well, you know, it looks like the Fed's going to hike rates this year, we should get out of, we should reduce our fixed income, or, you know, the market's been going on, 3 years ago the market's been in a bull market, we should reduce our equities by half. And it's so tempting to do that, but more times than not, you're wrong. And it's just not a winning strategy, and people get into trouble doing that. And then the other thing is to underestimate the likelihood of negative outcomes. And this happens a lot when we go through asset allocation studies, and you'll see in the 1% or 5% tile, the loss that you could potentially realize, and a lot of times people underestimate that actually can really happen and don't mentally prepare for it. The next, on page 11, the next bias is probably one of the most insidious ones that you see in life, and it's not just investing, which is confirmation bias, and this is the tendency for people to seek out information that confirms what they already believe. And you see this everywhere. You see it in politics, you see it in the media, you see it in the investment industry. It's probably one of the most pernicious things out there. In the investment setting, it can play out in a variety of ways. It can play out in overemphasizing when you're looking at managers, time periods when they outperformed. It can just simply being ignoring data that is actually very relevant to the decision, but doesn't fit into what you, or your preconceived belief as to what the situation, what you want it to be. We listed a red flag statement here, but this is something that is hard to defend against, and it is something that is probably best defended against by, we'll get into this a little later, but again, being very objective in terms of what your goals are and collecting data in a very systemic way to support or refute and being open to either way. The next bias is called hindsight bias. This is actually a pretty interesting one. So it's the inclination to see events that have already occurred as being more predictable than they were. And this can go both ways. This is, you know, if you have to simplify this, it's judging the outcome rather than the quality of the decision. Because, you know, the thought is you should have been able to predict that outcome. And you actually see this in two different situations. In one, it can be confusing bad luck with the absence of skill. For instance, if managers recently underperformed significantly because of the recent tariff announcement from the administration. Is that something they really could have predicted? Probably not. And good chance it'll rectify itself over time as well. But the other one that is often underestimated is confusing good luck with the presence of skill. And you saw this a lot with I'm not referring to you. The thing I'm thinking about is in the financial crisis, you had a few hedge funds that just crushed it. And to their credit, they made bets that did pay off, but there's also an element of being in the right place at the right time. They did the analysis, they came to the right conclusion, but they were also just happened to be in a place to see that, and a lot of these funds have not repeated. And that's a good example where it can be hard to differentiate sometimes, but just because a fund has hit the cover off the ball doesn't necessarily mean that it's a repeatable skill. And it's very hard to differentiate that, but that plays out a lot in the investment industry, and it's, you hear it as chasing winners, but it happens a lot. The last one is familiarity bias, which is the inclination, this is on page 13, the inclination to favor investment choices or service providers that are just familiar to the decision maker. And this plays out in a lot of ways. It's the reason that there's an advertising industry, I guess, is to build brand recognition, and people associate brand recognition, knowing people, with that means that they're going to succeed in whatever we are hiring them to do. And it's something to be wary of. Again, another defense against this is making sure that you have decision factors independent of brand. And some of this can be important. I mean, if it's a large organization, it does reduce some risk rather than going with a hole-in-the-wall company, but really relying on the data less than if you're familiar with this person, you're familiar with this brand before making a
Everything I
decision.
normally rely on. What's left? I got everything, you've got everything I normally rely on.
Sorry. After I read these books,
attorney?
so why don't I pause there again? I know I've gone through a lot. And I'm probably not doing it justice. I'm going to give a couple books that I do think would be good to read, because they go, first of all, they cover a lot more than I've covered here, and they go into some of the supporting research that this stuff actually is real. So, page 14, there's got to be a solution to this, right? I'm not just telling you everything that you're doing wrong. So, how do we manage our biases? And, you talk to, well, I can talk to him, but I saw an interview with Daniel Kahneman, and he's pretty pessimistic. He says, we all have these things. There's really not much you can do about it, but the best you can do is essentially be aware that these biases exist and manually correct for it. I listed a quote here from Ray Dalio. He's pretty much the most successful hedge fund manager ever, and he's a lot more than that. If you read his book, Principles, it's kind of like he's more of a philosopher and just the best decision maker, systemic decision maker that I've ever seen. And I have a quote here that kind of gets into how you manage biases and be more analytical, and essentially just embracing reality for what it is and not wishing. That's a big theme of this book, not wishing reality is what you want it to be. And there's a book at the end of this that I definitely recommend reading, which helps you to make better decisions. So some tips for managing biases I've listed out. I'm not going to go through all of them, but in detail. But the main thing is to have a systemic way, and this is something that we work on with our clients. We're exposed to these biases as well. That to have a systemic way of clarifying what your objectives are when you're approaching a decision, determine what information is necessary, and being open to the fact that whatever data you collect may convince you the opposite of what you want to do, if you do have a preconceived notion. And then really thinking hard, and this is something that we encourage clients to do, it's something that, believe me, we do ourselves, really thinking hard when you're faced with a decision, when you're going to make a decision, what is honestly motivating you to make that decision? Is it, do you have something to gain from it? Is it something that, are you pursuing a decision that is very popular? If that's the case, is it the popularity itself that is driving you toward that decision? These are questions that I think people often don't ask themselves, and you'd be surprised how many times when you really think through why you're deciding to do something, that there may be motivations in there that aren't necessarily stated in terms of what the benefit of the decision is. So in conclusion, on page 17, I did want to provide some recommended reading. Did want to provide you a glimpse of these biases. Hopefully it helps out with some decisions in the future. We grouped the 3 books that have been bestsellers and are actually pretty good at explaining several of the biases that you've seen and other biases that you haven't seen. There's a Michael Lewis who wrote The Big Short. It's kind of a very, very high-level book. And then if you want to dig into a little more detail, there's a book called Thinking Fast and Slow by Daniel Kahneman, and Misbehaving, I put that third on the list, by Richard Thaler. And then I mentioned Ray Dalio before. His book Principles is really, there's so many themes in it, but one of the biggest themes is that a lot of the decisions that people make are based on emotion, number one, and number two, preconceived wishes as to what they want the world to be rather than what the world really is. And he has some pretty excellent principles that I can tell you personally has changed the way I've made decisions and will really make you look at the world differently. So with that, I'll open it up to final questions. Hopefully this is somewhat entertaining. Not the deepest topic, but it actually is pretty important to keep these things in mind.
Thank you.
Great.
Okay.
You should be rich and retired.
What's that?
Since you learned all these decision making.
Continue to make good decisions.
Not retired yet.
Not retired, that's right. Well, to end the day, we're going to talk about performance. And sorry for you to have to put up with the voice I've got today. Allergies are just really full-blown at this point in the Willamette Valley. So maybe if it's here for a couple more days, I have a better voice for you. But I'll turn you first to the executive summary, which is the written summary of the performance that you experienced. And the first quarter was a tremendously strong quarter for the markets. It felt like an inverse mirror reflection of what we actually saw at the end of the year. And it was a refreshing change to have optimism built back into the marketplace. We saw nearly every asset class recover significantly from the prices that we saw at the end of the year. And it seemed that investors were embracing risk once again. The S&P for the first quarter, or the large cap market here in the US, was up 13.6% in one quarter. That's twice the amount of return that you saw in expected returns at our asset allocation last time we were together. The small cap market was up 14.6%. The international equity market in the developed world was up 10%. And emerging markets were up nearly 10%, and even bonds were up because interest rates went down in the first quarter. They were, the aggregate was up 2.9%. So we saw some very nice productive returns in the first quarter. Some of the factors that drove, it seemed to drive investor behavior at the bottom of figure 1 on this page 4, is that there was renewed optimism about the U.S.-China talks. Obviously, in the last couple of weeks, we've seen a lot of doubting of those positions, and you saw today some of the sanctions on the Chinese cellular phone manufacturers been lightened a bit, or a little bit of optimism there. But when we were going through the first quarter, there's a little bit more of a brighter outlook than there was at the end of the year about the ability to come to some kind of successful terms in those negotiations. We also had the Fed not raising interest rates again, keeping them where they were. And I thought it was a terrific display in Bloomberg showing you what the yield curve looked like and the dot plot situation looked like. So the Fed, at the end of the day, as I think Mike said last time we were together, has given us a little room now, or given themselves a little room to react, where if the economy does start to weaken at this point, or if there needs to be some kind of intervention taking place. But it's still not a lot of room if you look at where interest rates are today. On the negative side of things, global economic growth seems to be slowing, both in the US and in other economies. So that's something that we're going to have to continue to deal with. Is we did see a lot of strength here in the US. In the corporate world, we saw some advantages from the tax reform that was done in the corporate world. But when we look really globally, we've gotten used to a growth rate, certainly in the US, that we may not experience going forward as consistently. And of course, there's the speculation about what's going to happen in Europe when Brexit actually happens, and what's actually going to happen in Asia as we look at what China's actual growth rate will be in the future. The yield curve inversion, you got to see that literally. You got to see the kink in the yield curve as you looked at that Bloomberg screen. And as was mentioned, there was some inversion that did take place in the classic definition of the yield curve inversion from 3 months to 10 years. In terms of the percentage of times that has foreshadowed an actual recession, it's been something like 7 out of 10, 8 out of 10 for the significant recessions that we've had. And the probability of a recession in our future is increased somewhat relative to what it was a couple of quarters ago. But so far, we haven't heard any doomsday predictions that it would be a deep and lasting recession. Obviously, we have yet to see data that points in that direction, but it's cause for just being realistic about what to expect in our economy, especially going forward. The index returns are on the next page. Tremendous returns as you look at Q1, and then when we factor in the 1 year that includes the end of last year, you do see some red numbers there in the international markets. The dollar strengthened during this period of time, which didn't help. Commodity prices were generally under pressure as well. But for the quarter, we'll take that kind of growth. It certainly helps our fiscal year.
Yeah, I've always had a question. When you do your predictions for stocks, it's low.
It's low?
In my opinion.
Yes.
But if you look at the long-term S&P 500, you know, and we're a perpetual fund.
Yeah.
So if you look at the 10-year figure, they're higher, way higher than yours.
Okay.
Tell me why that confuses me.
These numbers, well, first of all, those annualized period returns move around a lot. Even though it represents a significant period of time, the end point makes a big difference. But the second thing I would offer is this is primarily showing you recovery since the great financial crisis. And so you're catching the upward movement of the stock market. And we know
But I think you can do that in most any 10-year period for a stock.
You can, but if you were to back the calendar up 10 years and recall those meetings when we were looking at the fact that the S&P 500 had gone nowhere for a 10-year period of time, right when we went through the financial crisis. So what we have done is, you're right, they are less optimistic going forward than what history has delivered, especially the most recent 10 years. Part of that is due to the fact that we believe stocks are fairly highly valued here in the US, and at some point we believe that there's going to be a mean reversion taking place. So part of that is our view that prices, it's hard to support prices at a high level for a long period of time. That's certainly part of what's driving our assumptions going forward. But you can't argue with a 16% rate of return for the S&P for the last 10 years. Yet, if I look at other consultants' predictions for the S&P 500, the broad U.S. equity market, and other money managers, I haven't seen a number that looks like that. Everything is much lower than that 16% rate of return that we got. So there's a lot of investors that believe that prices won't continue to grow to the sky, or trees won't grow to the sky, whatever the metaphor was in Mark's presentation. Plus, you know, at the end of the day, we're fiduciaries, we need to have a realistic view about what's possible. Not an overly pessimistic view where you're constantly feeling like the sky is going to fall, but a balanced view. And that's really what we try to deliver for you. As you look down the rest of that list for the quarter, it's not surprising when you look at some of those asset classes that you participate in that you got a 7.3% rate of return in the retirement plans in the first quarter, net of fees. When you look at the S&P 500's return, the small cap market I mentioned, the international markets all delivering something like 10%, and then our bond portfolio. So really a very strong quarter on the backs of a lot of good asset class level performance.
Yes, question.
Sure.
Why did we then lag so much the public employees benchmark? Because we're overweight the S&P 500 according to most of them.
Well, the benchmark is how we're actually invested, and then the rank is relative to your peers. So the peers are the greater than $3 billion public plans, and you don't actually see that median return in this chart because we were trying to save room on here. But relative to other plans in the quarter, you ranked in the 42nd percentile, but relative to your benchmark, you were behind the benchmark by about 3%. And a lot of that is your illiquid asset classes that are being measured relative to a public liquid benchmark.
Oh, okay, so the public employees benchmark is not how the other plans work.
That's how you're invested on an index basis. And then you'll recall you use a small cap benchmark for your private equity returns, you use a REIT index for your real estate returns, and the same philosophy for natural resources. So there's going to be a mismatch, especially when you get a big upward or downward movement in the market. It's not going to reflect what those private investments have actually done.
This is probably a bigger question, and I think I know some of the answers, but we're not trending the right way here.
And I'll tell you why. Actually the trend is absolutely solid. When you look at this particular quarter, what we find, and look at the 1 year, and you're in the top quartile. So for the quarter, and for the fiscal year to date, what is driving the quarter as we look at this particular point in time is that you have more real estate than other plans, and that real estate is not tracking, the illiquid real estate is not tracking the movement of the equity markets. You also have a bit more in the fixed income side of things than other plans do. And it tended to underperform some of the other alternative investments that other plans have had. And so let me just give you a couple of quick numbers for reference. This isn't in your materials in front of you, but I did pull it up because I anticipated your question would come up. So relative to the other public plans greater than $3 billion, there's 53 in the universe, and you also get similar information from State Street, so I'm giving you our numbers that led to that ranking. You're in the 28th percentile for U.S. equity exposure that you have. The median plan has 23%, you have 30. International, you rank in the 59th percentile, you have a little bit below median international equity exposure. The median plan had 18, you had 17. If you look at fixed income, you ranked in the 27th percentile, so you're nearly the top quartile of other plans and how much fixed income you have. Basically, you have more fixed income than you do, and other plans have more alternative investments, like hedge funds and other things, than what you do. And because fixed income returns were positive and good for fixed income, but absolutely trailed some of these other strategies, that's one of the impacts on ranking. And alternative investments, which is a combination of private equity and hedge funds for the biggest part. So your diversifying strategies would be in there, as well as private equity. You have 14, the median plan has 20.
Oh, so that's a big difference.
In real estate, you have nearly 9, and the median plan has 6. So again, it's those illiquid asset classes that aren't marked to market, reflecting the full market appreciation of what happened in the private equity field, for example. You just won't find that those returns are going to track closely. All right, let's see here. So the trend we're not concerned about at all. We did talk in the asset allocation about the mixture, and so does Joe in his reports about where your international equity investments are relative to your U.S. equity investments, because you do have a larger proportion there. And that's, that structure has really led to the very strong returns that you've experienced in ranking relative to other plans for that 5, 7, and 10-year period. So let's go ahead and move to page 10 briefly. And this is just a bit of a pictorial snapshot of a few things I'd like to take you through in the next couple of pages. First of all, it's hard to remember how good things are when they're good. We tend to look back on the good times once we're in a bad time and say, oh gosh, that was a great meeting. I remember we had very low unemployment. We had great returns in the equity markets. And the upper right-hand section of this page gives you a little bit of a perspective. Look at the unemployment rate relative to history. And this is showing 3.8. We're at 3.6 now, as you know. Inflation is about in the middle of the pack relative to what we've seen in history. Look at where U.S. government debt is. In our rosy picture and our cautionary picture, keep an eye on that diamond. It has not moved substantially in a better direction. VIX is showing you the volatility of the equity market. That really spiked as we went to the end of the year. It spiked in 2008. It's very low levels here, well below median. And look at consumer confidence on the upper right-hand side. So people are buying, people are spending. The other thing, the yield curve you looked at on Bloomberg, but if you want to just look at a color expression of it relative to recent quarters, bottom right-hand corner, you ended March with that bright green yield curve, and the end of the year is the light blue. So you can see we've dropped across all maturities, and there certainly was a kink in the yield curve at the end of the year, and it's a little deeper now. Just a couple things on equities in the U.S. on page 11. Valuation. I mentioned the price of U.S. equities. We need to keep an eye on it, especially in some areas like small cap growth or small cap generally. If you look at where the blue diamond is in the rightmost bar under valuations, look where that blue diamond is. It's almost near the top quartile of valuations for small cap. Small cap is expensive in the U.S. And when we look at the valuations for the U.S. equity market, because we did have that correction at the end of the year, valuations have gotten a little bit better. Now we had a good quarter here, but stocks aren't cheap in the U.S. If you look at how various sectors did, that's in the bottom right-hand corner, call your attention to just look at the numbers. It's quite amazing. The best performing sector for the quarter was technology, up almost 20%. And the weakest was healthcare, with a modest return of 6.6% in the dark blue. So quite strong there as we look at almost any sector for the quarter. And in the international markets, the thing I'd like to point you to is the bottom left-hand corner for valuations. Notice that the blue diamonds are more towards the bottom relative to the U.S. equity market. Something to keep in mind, mean reversion. And then the bottom right-hand corner, this shows you various regions for equity performance, and you can see that all regions were positive for the quarter. Some were negative for the year in the lighter blue. Japan is one, emerging markets is another one, and so is Europe without the UK, and the UK modestly negative, close to zero for a year. But for the quarter, all regions were positive. Canada is really driven by natural resource prices, and so that's one of the reasons it had very strong performance. The bond market, the next page, page 13. Upper right-hand section, the bars are a little shorter here, returns are smaller, but they're all positive, and the best performing sector of the U.S. bond market was high yield. Shouldn't be a surprise. Now, you have more conservative high yield managers as a rule, and so they're not shopping in the junkiest junk, which tends to do very well when high yield is running, but a very good contribution to your overall return. but all sectors did quite well. If you look now at what other alternative investments are doing on page 14, on the right-hand side, you can see how real estate did. There's 2 measures, actually 3. The NAREIT is a REIT index. You can see also how the NCREIF did. Much more modest returns for the illiquid real estate markets in the Odyssey benchmark and the NCREIF benchmark. Again, properties aren't appraised with the rapidity that our stocks are priced in the marketplace, as you know, but REITs are. They're daily valued, and look at the large return you got in REITs. And then you can see the natural resource stocks actually had a good quarter as well. The good old quilt chart, this is the modesty chart telling us all that we can't predict easily what asset class is going to be in favor. There's a couple of interesting trends here that you can see on this chart. If you look at the bottom, 2012 through 2015, commodities ruled the bottom of the roost, if you will. Very difficult returns during those periods. And then cash is about where you would expect it would be in stronger markets as we look at 2016 and 17. And then cash became the hero in 2018, as you know, only outperformed by real estate. But on the right-hand side is the current quarter. And the way you can read this is REITs were at the top. Securitized real estate, liquid real estate was at the top. The green colors are U.S. equities, the blue colors are international equities, and then we get into fixed income categories. So very much a risk-embracing quarter. And cash is at the bottom where it should be. So with that, I can move with you to page 2 of the performance report. It will be the summary of returns. It should say comparative performance, upper left-hand section, retirement plans. And I mentioned the 7.31% rate of return. Everyone find it? I have the electronic version.
Page 7 for us.
Okay, all right. Keep me on track then as I move you through. Page 7, you said? Okay. So when you look at the returns for the retirement plans, you can see on the left-hand side that 7% rate of return that I mentioned across the PERS and TERS plan, and then you see the police plan at the bottom. And a bit of underperformance, as we mentioned, for the quarter, and you'll see the details of why in just a couple minutes. If you continue on the next couple of pages, you'll see the other retirement plans. But I'd like to go ahead and point you to what should be page 12. It has the green pie chart. No, pages aren't tracking.
Oh, the this one here?
Yes. So what's that page in yours?
Page 6 and 5 have the pie chart.
Okay, well then we're back to the pages that match mine. Okay. So page 5 actually has the pie chart at the bottom. And it shows you the retirement plans and the size of the cap pool versus the short-term investment pool, 11.3 billion and just under 400,000. The next page should be the asset allocation of the investment pool. So this shows you the cap versus the short-term and trust fund pools. So this is capturing all $17 billion in assets.
I don't think we're on the right page.
No, we're on,
No?
so we need to go to page 14, it looks like. Asset allocation investment pools as of March 31.
Okay.
So 14 for us.
Okay.
With the green, yellow, and blue.
Yep. This page?
Nope.
Nope.
That is 16.
16.
Okay. Looks like the electronic version I got, but I keep changes. Thanks so much.
Keeps us on our toes.
Yes. Absolutely. So if you look at the page 15, you can see that on the left-hand side, you've got the consolidated asset pool performance. You've got the trust fund pool, which is primarily fixed income at 3% rate of return, and then the short-term pool with a return of 62 basis points. And if you turn to the next page, you can see the consolidated asset allocation for the cap. And this is just showing you the overall structure among asset classes. On page 16, you can see, pardon me, the overall equity exposure that you have, including private equity, is 60%. Fixed income, right about 28%. Real estate, natural resources, about 11%. And your diversifying strategies, about 1%, when you combine all of those related colors together. The following page shows you the returns by asset class. And this should be page 17. Domestic equity had a return of 14.5% ahead of its benchmark. International equity, 11%, and above its benchmark. Broad fixed income, 2.7%, and the investment grade debt, a better return of 3.7%. U.S. Treasury and agency, 1.7%. High yield, as I mentioned, a very nice addition to your returns. And then the mortgage-backed portfolio, 2.3%, TIPS, 2.6%, natural resources, 60 basis points. And so when you look at many of these asset classes, you outperformed your benchmark with just a few exceptions, and we'll talk about those in a moment.
Maybe this is a question for Joe. In our diversifying strategies, at this point, it's just the long treasuries, right?
It is the long treasuries, but there's also two managers in there, multi-asset class. So we did that profile on one fund is run by GMO and one fund is run by PIMCO, but both are less than a year at this point.
So if you turn the page, you can see the balance of the asset classes, real estate, diversifying strategies. It was a very good period for real estate for one quarter at 2.4% rate of return. But again, your benchmark is that REIT benchmark, which I mentioned is a big difference for this particular quarter. And in diversifying strategies, a very good quarter as well. And I'll show you the details in just a couple of minutes.
What did you say about real estate?
Real estate is compared to a REIT benchmark, and the illiquid real estate portfolio didn't keep up with that REIT benchmark. REITs just had a stunning quarter that was related to the performance of the equity market in general. This is just a mismatch that you'll find in your benchmarking when we get big market moves like this.
We always have a mismatch in the benchmark.
You do with all your illiquids. No matter what your solution is, you will have these periods.
I've got an idea, 4% above 500. And then we can discuss it for 15 minutes every meeting.
Oh, for God, no.
Oh, we did that for about 4 or 5 years.
We did, yeah, we did.
Changed the benchmark, but we're still off.
Yeah, and you will be. It's just the issue of having a flat benchmark or public equity benchmark for illiquid assets. Yeah, you did a great thing to try to show you what you would have earned in a similar strategy in a liquid market, and that's the philosophy that you got. So the private equity pool is on page 19, and you can see its performance. Again, it's not going to keep up when the marketable equity market is just surging ahead. But you can see the long-term return patterns here. So when we look at how other public plans did in these same asset classes on page 20, you can see relative to other plans, their U.S. equity segment, we ranked in the 20th percentile. In international equity in the 42nd. Broad fixed income, this is quite a combination of fixed income strategies for other public funds, so I wouldn't be concerned about a 78th percentile rank here. Others have more high yield than you do. It's just quite a non-homogeneous basket. And then the trust funds investment pool, we compare to fixed income. Pardon me. And then real estate, you rank in the top half easily compared to other plans.
So on broad fixed income,
Excuse me.
you know, I'm looking at the trends. Could you talk about that over different periods of time?
Absolutely. Now, as I mentioned, other public plans have, there's not a real homogeneous way that constructed their fixed income portfolios. Some have included private debt in those portfolios and a lot of high yield. This, you've changed strategies in the last couple of years to break them out into their separate components and look at each one of those rather than having a manager make that decision on which components to be in. If you look at your longer-term history and more of a reliance on investment grade strategies and less diversification into non-investment grade, you're ranking about median, and it's improved recently because of your overall structure. So it's an improving trend in fixed income.
Do I get credit for asking enough questions you lose your points?
Yes. I'm gonna see if I can outlast you. I'm gonna have to resort to sign language.
He only understands
The
a
thumbs up or
couple
the
of
thumbs
signs.
down.
Yeah, I can get.
I certainly won't blow out my metaphor budget, but I know that doesn't apply to me.
Becky, just
Yeah.
quickly,
Sure.
as we look at these numbers, we've now had, at least since I've been here, a bad quarter and a good quarter. And relative to a minute snapshot in time,
Yes.
it looks as though we're pretty well correlated, that we're hedging against
Mhm.
each individual
Yes.
movement.
Yes.
Thumbs up?
2 thumbs up. The only caution would be that we are more dependent on the US equity market. And that's something we just have to be aware of. But that's something we have to be aware of. I'm going to skip over beta and the trust accounts and move you through the equity composites, just so you get an idea of how these various investments performed on page 26. And we have various ways of dividing up, as you know, the various types of equity investments that you are participating in. Pardon me. But long-term, you can see the rankings are holding up pretty well. And underperformance, there's been some underperformance in mid-cap equity that you've seen. There's been some manager changes that I know you're aware of in that space, but there isn't any big concerns here to communicate to you. And when you look further back, pardon me, into international equity, you can see the relative performance compared to your benchmark is better, but your peer rankings are a little worse. In some cases, when we look at some relative rankings, but overall, your international equity investments have held up pretty well compared to the benchmarks here. Pardon me, I'm so sorry. I'm good. I've got everything I need right here. Just need my voice to carry through for you. So really, the only other page I was going to cover is to look at diversifying strategies. And let's move back a few pages. To page 48. Just so you can get a sense of how the components of this portfolio perform. But all components had a return in the 5% range. So, worked out very well. And PIMCO had very little exposure to the US equity market. They still did well. And same with GMO. And interest rates went down, as you know. That helped your long treasury portfolio. So your portfolio is in a good position. Asset allocation is still the most important thing we continue talking about here. And we don't have any big overriding concerns to talk about today.
Yeah, Becky, I've got a question to follow up to what Dan asked, and something that you talked about last time.
Okay.
So that maybe I got a better idea what I'm doing here. Last time you talked about that asset allocation, the most important thing that we can be involved in.
Right.
And that there were three, kind of, as I understood it, 3 parts to that: standard deviation, correlation, and diversification.
That's right.
So that's at a strategic level.
Yes.
And I think, I'm not quite sure my question here, but it seems to me that if we're accomplishing what they're trying to get us to accomplish at the asset allocation level. That now within those asset allocation classes, if they're working right, they're not all going to go up or down the same.
Correct.
So it's actually a good thing that there is some difference
Yes,
between those asset allocation
yes.
as we go along, because that means it's working the way it's supposed to.
That's right, that's right. The same can be said of manager styles and sub-asset classes. But if you turn to page 12.
Well, that
And
was
then-
actually going to be a follow-up question for you, but also maybe for Joe.
Yeah.
Because it seems to me that those three things, standard deviation, correlation, and diversification, aren't just a good thing for the board to decide asset allocation, but for Joe and his team to look at asset management.
Absolutely. If you fill your whole U.S. equity portfolio with quantitative growth-oriented managers, you would have been happy the last few years.
Yeah.
But not when that turns around.
Right.
Yeah.
Okay. Maybe I'm starting to get to where I
Yes.
understand every third word instead of every fourth word.
Yeah.
Okay.
And on pages 12 and 13, I was going to point you to the risk return charts, upper left-hand section of each page, 5 and 10 years. Compared to other plans.
Sorry, Becky, which page?
I'm sorry, page 12 and 13. So I'm moving you backwards. So you see a risk return chart? So relative to your benchmark, you have much better return and risk performance over time over the last 5 years. You see the green diamond and the blue dots? The blue dots your benchmark. And all of the other plans are in gray squares. So you have just a little bit more volatility than the other plans out there, but a lot more return over the last 5 years. If you look at the next page, page 10, you can see the actual performance is curves. You're in the upper left-hand chart. You've had less volatility than over time. So your asset allocation is working relative to peers and relative to your benchmark.
And just to make sure I know what I'm looking at, you want to be in the upper right hand.
Upper left, actually, would be preferred.
Upper left.
But,
Page 13.
excuse me. The other cautionary note I'd offer here that actually gets to Jack's question about that 10-year time frame of returns and how good they've been. We've also been in a very low volatility market. Look at the numbers for standard deviation or risk in those two charts. They're all 3 to 8, 4 to 9.5. We're predicting as we go forward numbers that are in the 12-13% range. We've had very little volatility. But we keep that in mind. We test what your portfolio would look like should volatility actually return to those long-term numbers.
So fasten your seatbelt, it's going to be a bumpy ride tonight.
Well, and I showed you where the VIX was, the volatility of the equity market, really low. So whereas we celebrate a quarter like this, we can't be complacent. We also can't depend on the last 2 years happening like it just did. Yes?
Becky,
Is that sure?
are you going to do anything on investment manager profiles?
I wasn't planning to,
Well, I
certainly
want to ask you
can't.
something on
Sure.
because when I looked at that,
Excuse me, what page?
well, this is on page 50. Well, I guess maybe the one I'm more interested in is actually 61.
61.
Under the, so just page 61, I think, of your overall report. So
Yep.
when I look at that, this is a 5-year, I'm looking at the peer group scattergram.
Is this for Iridium?
Yes.
Yes.
And so Iridium, the way I look at that is if you're to the right, I can't remember my X's and my Y's, but this one, all right?
X.
Then you're taking more risk.
Yeah.
And if you're under, you're getting a lower return. And so this manager, over a 5-year period, this, I guess I'm asking you to see if I can understand it, is taking a lot more, there's a lot more volatility, and there's a lower return. And so at what point would you tell us that you probably need to, or Joe, you look at these
They've been
guys?
terminated.
This is the manager that we'll talk about tomorrow as part of the termination that occurred at the beginning of April.
Yeah.
Well, these guys are gone.
These guys are
Okay.
gone.
All right, so would the same be true for, I guess the other one that I looked at was, although this is only a 1-year period, this is Jacob's Levy, it's just way out there on the risk of the side. Was that one that's gone through?
No.
Okay, is it just too early? Okay. All right.
So that's a good point. Becky, do you guys ever advise us that we should probably look at some of these managers and say,
Absolutely.
hey, they should, so you had that conversation
Staff
with
is
Joe
looking,
then?
we're looking, and we collaborate, absolutely. Now, our manager research department has a team assigned for every asset class. And they're independently looking at every manager that our clients have exposure to and prospective managers. When there's a change in a portfolio manager or a company changes hands, or if they change their model, say it's a product that uses a computer model and they change it, or if they have some kind of legal issue, they're coming out with those independent views and sharing them with all of our clients that have exposure. So yes.
There was a big move last month. Were you guys involved in the decision to, terminate a bunch of the managers?
No, we on an ongoing basis have conversations with your staff about what's going on, but not necessarily in all the timing or the grouping of managers. But yeah, we're a constant resource and are available at any time for that collaboration.
So do you have those conversations though with our staff? That's kind of, I guess, what I was getting at.
Yes.
If you see something like that, would you contact Joe or one of our other staff members?
Now, obviously, there was a batch of them that were done in a deliberate decision to restructure and refine that portfolio. That's a little bit different conversation than an individual manager, but it was a collection of a number of them. When you look at their characteristics, you can see a lot of them were underperforming. But we have, in many cases, quarterly calls with the managers. Your staff does as well. I think in the past we used to have them together. We actually have them separately today, but we're going to share all that information with your staff on an ongoing basis.
But you don't sometimes share that though with the board.
What we provide to staff?
Yes.
We would be happy to, absolutely happy to.
I think that's where we're going to run into one of those delegation issues of, within the approved ranges of the asset allocation, within the governance policy as it's currently structured, the individual selections are up to staff.
But I guess what I'm worried about, Dan, is surprises.
Right.
So, to be honest with you, I think the scope of that last move was surprising.
Yeah, we weren't on that.
And so, what I'm trying to get from you, and maybe it's more a question for Joe, but Joe promises and mostly delivers, no surprises for the board. But I just want to make sure that there's some kind of process, maybe working with you, or I'm not sure, but I'm worried about surprises.
Sure.
Under that, we've instituted the now first, second reading practice within the IPS and the asset allocation, which are those two very core things that you direct us with In addition to that, we've implemented a new notification structure to both the audit committee chair and the board chair relative to terminations, whether that's for a performance issue, whether that's for a strategic restructuring issue. So we have more provisions in place to prevent exactly what you're talking about. Certainly, I think there's room for improvement in everything we do as long as we're dedicated to constant quality improvement, but those are the immediate steps we've taken. And I think it puts us in not only a better place relative to making sure the no surprise rule is obeyed by staff, but also the ensuring that you feel that we're respecting the delegation that you have granted us.
I guess I feel when we got Becky here, that somehow she works for us, not the staff.
Yes.
Correct.
And so somehow the consultant is sort of in that loop, the no surprise loop too.
Right. To the extent that we know of what is being, we're not always in the loop when there's a decision to terminate in the day that is, meant to be.
Well, and that's probably proper. But
Yeah, absolutely, because we're meant to be a resource. But we want to fulfill whatever it is the board would like to see to make their fiduciary responsibility supported further. And as you look at various delegation models, sometimes what's done, in the past before there was staff delegation, you were seeing every termination request and all the data behind it and our recommendation right alongside. That's totally fine. For other models where there's staff delegation, a lot of that's happening in the background. And so, to your point, I think that having a structure that you feel comfortable with where you see what's going on in the background, and whether that's saying, the RBK consulted and agreed with this, or whatever you want to see is absolutely what we're comfortable doing. Another client that we've got that has staff delegation as well will actually go through, and in the list of managers terminated and managers hired, it will say, and consultant agreed, or there'll be a joint memo. So there's all kinds of ways that you can get at that level of comfort for you. But we absolutely do work.
one of the things that I thought was very helpful in my banking career is when we had a bad loan, we reanalyzed it and see what we might have seen differently. No one perfect what happened.
Sure.
But is there a way that we can analyze why we had a certain manager and then it didn't work or something like that?
Absolutely.
As a learning, what I'm trying to do is make sure we do our duty. I think our model is great in the delegation. I don't want to see managers here every day or anything like that.
Asset allocation,
But I want to make sure that I understand, I'm always looking to risk, and I think sometimes when things don't work out, sometimes when you analyze why they didn't is more helpful than saying, boy, this was great, or whatever.
Absolutely.
So, I don't see that feedback from her sometimes.
And I think that that is an important thing to know, and again, the same client I'm referring to that has the same staff delegation. It's interesting because in the report to the board, they'll also say the reasons for termination so that the board gets a flavor for what that was, performance, change in management, all the things I just mentioned that we would report proactively to you on. And another one is lack of staff conviction or staff and consultant conviction, because you can also have a manager that isn't necessarily the big underperformer, but maybe it just isn't a logical part of the strategy going forward. Maybe it doesn't deliver something that you need in the portfolio. Maybe you've decided if you concentrate managers more, you can get a better fee schedule from the ones that you keep. But there are a lot of that diagnosis that can take place because, if you look at this Iridium manager that we were looking at in the manager profile page on page 61, one of the things that you can see is that whereas they had returns when you look at 1, 3, and 5, you say, my goodness, this record looks terrible. When you look at the individual years, there's just a lot of tracking error relative to the benchmark, to the good and to the bad. And so when you look at that and say, what kind of structure do I want going forward, that tracking error is part of the thing that is a little harder to live with in the portfolio. And it just so happens when we look at this particular mid-cap value manager, and one thing you need to know too is value's been out of favor for a while. So this has been a tough fishing pond for them and their particular implementation of value and private market value as they implemented. If you look at the up versus down market scenarios, you can see that over the last 5 years where they've underperformed by almost 5%, or excuse me, 2% over the last 5 years, it's during the down markets when they lost their edge. They kept up in the up markets, but they lost in the down markets.
Well, in the quarter that just passed, they were the #1 in the country, right?
Yeah. So in some cases, it's an interpretation of that record to say, does this fit with us anymore in the structure of it? But yeah, we're completely flexible in terms of what kind of reporting would make you comfortable. Or if you'd like a description of what we're doing, we'd be happy to provide that to you as well. Any other questions, manager level, asset class level?
Very good, because she's running on E.
You know, it actually started to come back. I don't know what the deal is. It's kind of cyclical, so I think I got past the rough patch. But I also know the clock is telling us it's getting on the day. But no, any other questions that you've got? Okay. All right, thanks for putting up with me.
Thank you.
Thank you.
People have been having that around here, I've had it for a long time.
What is now?
People have been having that cold around here, it's been hanging on for like 8 weeks.
It feels like allergies.
But it could be, I'm just saying there's,
Yeah. I was going to say, Joe's not going to touch his picture.
That's probably.
All right, thank you.
Everybody saw the note on the dinner, right?
Yep.
Okay.
All right, thank you, it's 8:30 tomorrow.
Bruce?
Here, hit this.
I've got a taxi driver coming.
turn until 8:30, oh, sorry. I was ready to go to dinner. Call me to order. When you're ready, please call.
Carl England. Mark Nonick.
Here.
Jack Crossrow.
Here.
Terry Cohey. Here. Bruce Nelson.
Here.
Diane Fladbo. Maggie Peterson. Here. Jeff Greenfield.
Here.
Jim Edwards.
Here.
Senator Sales. And Representative Hamilton.
Here.
Okay, now it's time to remind you that you're being recorded on video, so to remember that, everything we say and do will be seen and recorded, besides which we also have pressers and all. And with that, we'll go to the public comment portion, which is anything that's within the jurisdiction of the Board of Investments, but not on the agenda. Anyone from the public who wishes to speak, come forward now. Good morning.
Good morning. There are two of us. I'm Vicki Warren from the Irvine Marriott in Orange County. And I'm going to get brief. So good morning, board members and staff. My name is Laurel Fish with Unite Here. First, I wanted to start by thanking you all for listening to our concerns, for responding to them in the ways you have so far. And we've always felt, like Montana, the Board of Investments has given us a warm welcome here in Montana. I'm here representing Unite Here's San Francisco Local 2 and LA, Orange County, and Arizona Local 11. Together, Local 2 and 11 represent 42,000 hotel and hospitality workers in California and Arizona. On behalf of our locals, I want to thank you for welcoming us to our meeting and for taking the time to hear our concerns regarding your investments and our industry via CBRE. We're here for two reasons this morning. First, because we represent workers in the hotel industry who are impacted by the investments that you've made. Second, because we believe in and fight every day for the right of hospitality workers and all workers to retire with dignity. Defined benefit plans, like the one that you invest for, are essential to securing that right. We're here to share with you information about your investments in our industry that we believe will help you protect and strengthen your fund for the benefit of Montana public employees, their families, their communities, and your state. Sexual assault and harassment are serious challenges that we face in the hospitality industry. Between 2005 and 2015, the accommodation and food service sector ranked #1 among all industries in sexual harassment charges filed with the EEOC. Every day, hotel housekeepers, many of whom are immigrant women, enter into the most intimate of guest areas, their bedrooms and bathrooms. In surveys that our union and its partners conducted in 2016, half of hotel workers who responded in Seattle and Chicago reported incidents of sexual misconduct and harassment at the hands of guests, managers, and coworkers. 1/2. But there's hope for change. Women who serve and clean in hotels and office buildings are standing up together and saying enough. 2 of Time Magazine's silence breakers, Juana Melara and Sandra Pesqueda, are hotel workers. And you're about to hear from Vicki Juarez, one of 4 silence breakers from the CBRE-owned Irvine Marriott, where your fund is invested. On February 15th, Vicki stood in front of CBRE's Irvine Marriott, together with several fellow silence breakers, to denounce alleged sexual assault and harassment at the hotel. In the Me Too era, we've seen how sexual harassment and assault claims can pose potential risk to investors. Examples include the Weinstein Company bankruptcy and the Wynn Resort's sudden loss of $2 billion in value following allegations of sexual abuse. There is now growing concern that CBRE may have issues with claims of sexual harassment and the way it handles those concerns. Just last week, shareholders of CBRE voted on a shareholder resolution calling upon CBRE to eliminate their policy of mandatory arbitration for claims of sexual harassment and assault, a policy that CBRE pioneered a decade ago. Financial leaders and pension funds are starting to take action to protect themselves from the potential risks. On April 24th, Vicki and her fellow silence breakers from CBRE's Irvine Marriott stood with California State Treasurer Fiona Ma and trustees from CalSTRS and CalPERS and other pension funds to announce their support of investment principles intended to address what the trustees called the looming threat posed by the recent wave of sexual harassment and misconduct that leaves companies open to significant operational, financial, and reputational risks. I encourage you to look at those guidelines and to consider adopting them. During our previous visits, you heard reports about the labor disputes at CBRE-owned Pullman San Francisco Bay and Irvine Marriott hotels. You should know that those disputes are only escalating. Just last week, workers picketed the Irvine Marriott to protest unsafe working conditions, including lack of training and exposure to hypodermic needles and blood. The California Division of Occupational Safety and Health has issued citations against the Irvine Marriott, carrying proposed penalties totaling $45,750 for 5 separate health and safety violations. In addition, the Pullman San Francisco Bay Hotel remains off the market, and to our knowledge, CBRE continues to be unable to find a buyer at the right price. So we believe that companies like CBRE will not meaningfully move to mitigate sexual harassment unless they are held accountable by their investors, their shareholders, and their employees. The way CBRE has handled the claims of sexual assault and harassment, the labor disputes, and its forced arbitration policies pose a risk to all of their employees, particularly hotel workers and immigrant women. We also believe that CBRE's handling of these claims may expose your current investment in Fund 7 to potential risk. We respectfully suggest that you not reward CBRE for its potentially risky behavior with an investment in Fund 9, unless or until the disputes and sexual harassment claims are resolved. And now I have the pleasure of introducing Vicki Juarez, silence breaker from CBRE's Irvine Marriott Hotel, to tell you directly what she's experienced. Thank you.
Good morning, my name is Vicky Juarez. I have been working at CDRE Urban Mario for 16 years as a web server. One of my coworkers was harassing me, calling me, and pursuing me to be with him and follow me at home. I reported this to the company, and they didn't do anything. This escalated to the point the police had to get involved to stop him, but the company suspended me and made me feel that I was a bad person. Management made me feel that I was a criminal for reporting this sexual harassment. When they suspended me, I was pregnant and I got very anxious and depressed because I thought I was going to lose my health insurance. What I went through is going to stay with me for the rest of my life. Nobody knew what I went through. I kept quiet for many years because I felt embarrassed. I decided to speak out because when we organized the union, I started talking to coworkers who told me they had similar experience. Also, I was inspired by Me Too movement, and my sister, who worked in other hotels, who are speaking out. I couldn't keep quiet inside anymore. It was too time for me to speak out. On February 15, I stood with 2 workers, Liliana Rodriguez, Gloria Garcia, and Leticia Vallejo, and broke my silence. We spoke for our service and for our coworkers who are still too afraid to speak out. We supported Leticia, who is also suing the hotel. And we demanded change because CDRE and Mario don't know what they need to stop sexual assault and harassment. We do. We have proposed protection like so-called panic button, closing public restaurant while we clean them, and kicking out guests who harass workers. Mario has still not agreed to our demands. So we are going to keep fighting until CBRE and Mario learn to listen. Thank you.
Thank you very much. Anyone else wish to speak about matters not on the agenda? All right, it closes the public comment period. We will move to investments, new commitments. No one's going to step forward.
Morning, everyone. Earlier this year, we made an investment to Golden Tree Stress Fund 3. They are a credit manager. This specific strategy is in a private offset vehicle. That's why I follow within the private equity group. They will make distressed and stressed trades and investments. I won't go through the brief, but I will say what stood out about Golden Tree to us is their historical performance in Fund 1 and Fund 2 on an absolute and relative basis. We're in the longest economic expansion period. It's getting close to 10 years. And in this strategy, which is focused on distressed and stressed credit, they've done very well in a benign environment, so we feel like they will do well in an absolute and relative basis. Should the economic cycle continue, or should there be a downturn, there will be additional upside for the opportunity.
Just give me an example. I understand what distress means, but would they initiate buying bonds that have already been issued, or?
They would do bonds and corporate loans that are already issued. So they would either trade into them at a low price and sell out of them, or they could potentially take on both in the hopes that they will go through a restructure of the company, so that they end up with their equity or some favorable outcome coming out of bankruptcy.
Do they actually go in and help manage the company? Because
no, they're not going to do that. So they will have us take a board seat or something like that. They are not going into these companies to own them. That would be more of a stress for control type strategy. Their intention is to either trade in and out of the position or to have a board seat and working through a restructuring.
Mr. Chair, how do you measure risk in these? I was thinking yesterday as the bond folks were talking about, rating their possible holdings and so on. I'm sure yours is very different, but from our perspective, how do we get a sense of what risk we're taking on?
I would say, as far as this being in the private equity portfolio, on the credit side, it is higher risk relative to our other historical credit investments, which are senior in the stack, first pay. This is on the other end of the spectrum, where bonds or loan values can certainly drop if they call it wrong, or if they go through a restructuring that doesn't work out in their favor. So I would say it's on the higher end of risk within a private credit portfolio.
And how did you determine that 50 million was the right amount?
Yeah, so that's with the help of RBK and some of their pacing studies, and thinking about our private equity versus credit, and that's how we've done it. It's historically and to date, our credit investments in private equity have been a little bit larger. That's because they call down capital and pay back capital a little bit faster. So we've upsized compared to equity, which has been longer dated as far as our investment goes. And the overall exposure we have over that investment.
So if they do a successful trade, do you get paid out right then, or does that go back to buy more?
So for a period of time, they will recycle the capital. But if it's a bond, they'll pay that back out. But the principal, when they exit out of that, if it's within the investment period, they would recycle it.
So I'm looking at the preferred return on this one and the next one you're going to talk about. And they're both 8. But they seem to me, at least, that the risk profile on each of those is a little different. When we look at that preferred return, 8 seems to be kind of like the standard you look for. But when we analyze that to Terry's question on risk, shouldn't we get a higher preferred return if it's a riskier type investment?
So we certainly look at the preferred return, and you're correct, 8 is the industry norm. I think a lot of people put 8 because that's what's always been there. We do analyze that. We haven't seen preferred returns really above 8 very often. I think that would be the extreme exception. We've seen a couple of preferred returns below that. I don't want to misrepresent the risk profile of GoldenTree and their strategy. Their return history has been very consistent for the last 2 funds, so that's 2010 till now. But within, and in comparison to the rest of our credit portfolio, it is on the higher end of that risk spectrum. But it's certainly not comparable to a VC strategy where you have more of a binary risk where it becomes a very successful company or doesn't succeed at all. So I would say specifically for GoldenTree, the preferred return seems appropriate considering market norms and this risk profile.
Maybe for Becky, so RBK is in discussion with our folks on this investment. Is this something that you would have multiple clients participating in?
We have multiple clients in the private debt space, and there's a lot of names that have been under consideration, and we've also helped in figuring out how much annually to contribute to private equity and debt in the private space and real estate as well to make sure that you meet your targets over time. So this particular one, again, I don't have the data as to how many others we have in that space, but certainly we could get that for you.
maybe just a second question. Would this be one that we discovered and bounced off of RBK, or one that RBK brought to us and you dug into?
Specifically on this one is one that we found.
Mr. Chairman, another question. I noticed 15% emerging market. I'm reading that they're allowed to go up to 15%.
They are allowed to go past that. I think that is kind of their historical norm and target, but should the opportunity dictate, they will go above that. And I think in the last couple of years, they have gone past that because they've seen more distress in emerging markets rather than US or Europe.
And maybe this isn't the way you guys look at it, but if you look at the whole private equity space you have, what percent would you say is in emerging markets, one way or the other? That may not be a way to think about it.
I'll have to get back to you on that. I would imagine it's probably single digits.
So that was surprising. This seemed kind of beyond what we've done in emerging markets and private equity. That was just because it seems higher.
It is, especially for credit. We don't have any emerging markets credit exposure within private equity. So this is us looking to have more exposure there and not necessarily just mapping to what we have had historically. So we do like their global focus to look at opportunities across the world.
I have a question. So like on this limited partnership agreement committee, it says yes, observer. Does that mean we don't have a vote, we just get to watch?
On this one, I think there were discussions about us taking a full seat, but it was the expectation that it would be highly active. And so we felt with the pedigree of this firm and their size that we didn't need an active vote. I felt comfortable with the current outcome.
This is a fund term of 6 years. Is that a hard close? If they're left with some securities, do they just have to clear out the barn at that point? Or
Yeah, I think at that time they would speak to the LPAC and see, and so it will depend on the fund. So the LPAC and the GP could decide to extend that out, or could ask for a liquidation of that sense.
Thank you.
Okay, if there's no other questions on Golden Tree, I'm Terry Colnick. Good morning, Mr. Chairman and ladies and gentlemen of the board. I'm here to talk about Sterling United Properties 2. We committed to $30 million to this on April 26th. Sterling Investment Partners is a vertically integrated retail specialist firm, and the team has been investing in grocery-anchored shopping center and other retail investing for the past 19 years. It began its dedicated core grocery-anchored shopping center strategy with SUP 1 in 2015. Basic parameters of the assets in this strategy are centers with grocery anchors that have solid sales and are number 1 or number 2 grocer by market share in the top 30 U.S. markets. These shopping centers will have high occupancy and stable, predictable cash flow. Other tenants tend to be service providers. Cash flows comprise about 75% of the total return and provide a strong cash yield component of 8 to 10% or more. Competition is modest because the small deal size and labor-intensive characteristics of managing grocery-anchored shopping centers deters many core real estate investors. But Sterling has a full team of asset managers, construction experts, and transactions people to help manage properties in a cost-efficient way that also attracts strong tenants and high traffic flow. Are there any questions?
Again, how did you come across this?
So we are always on the lookout for good managers, but we were particularly on the lookout for a retail specialist because of all the problems that we've seen in the news about retail, and determined that grocery-anchored shopping centers were the least volatile, and for the past 5 years they've outperformed other retail segments.
Terry, real estate arena, the GP commitment here is 1%. Is that common? Is that low? If we look at it compared to the previous one we just talked about, I think there's more like a 5% commitment there.
So Sterling, it has a value add series. There's 3 funds in the value add series, and the team has been contributing to all 3 of those funds plus SUP 1. And because they're not fully realized, in fact, some of the funds are only barely realized, they did not have the money to put more than 1%. It's kind of our minimum is 1%. And so when we talked to them about this, we decided that that was fair.
No concern particularly about their shared commitment to this?
No. You know, when we examined that the commitment came from several, numerous team members, and the largest amount came from the leader of the firm, we decided that, you know, the whole team is very committed to this fund and its success.
I will add that we look at it from an absolute and relative standpoint. So I would say industry average would be more of a 2%. But even that is not where we would stop with the questions. We would ask who is committing, how much is committing, how much do you have in all the other funds, to get a sense that they have skin in the game. And that's what we're really looking for, is that alignment in their commitment with ours.
Thank you.
Thank you.
Mr. Chairman, I'm sorry, didn't catch this until just a second ago, but back on, and apologies for this, back on Golden Tree, I noticed under law jurisdiction, it says Cayman. Is that a...
Not uncommon. So I think most of the privates would either see Delaware or Cayman, nothing uncommon. Anything other than that might be outside the norm. But the Cayman structure, I think, is more so efficient tax vehicle for these managers. And so, nothing outside the law.
Is that an illegal offshore account?
No, I think when we went through all of ours, you would see other Cayman vehicles. Very, very common.
It is very, very common, although it sure sounds strange when you hear it for the first time. It's actually pretty standard.
I probably heard it, it's the first time I noticed it.
Right.
Probably less important for us with the tax exemption, more important for high net worth clients who are more sensitive to the tax. And so that's why there's a tax vehicle.
Mr. Chair, I'm wondering if the chair thinks it would be appropriate for some of the board members to kick the tires at this.
That's what I was saying. There's literally cameras on both sides.
Thank you.
It was a joke, right, Jim?
It's a joke.
Good morning, everyone, members of the board, Chairman. I'm Emily Kovarik, investment analyst on the privates team. I'm here to talk to you about 2 other commitments that were made since the last board meeting. The first one will be to discuss is Kimmeridge Energy Exploration Fund 5. We did a $50 million to Kimmeridge. This is a re-up with an existing manager that we've had. The commitment continues our exposure to a manager with a proven track record in effectuating successful direct investments in unconventional oil and gas. Of interest to the board is that our commitment to Fund 4, which was made in August of 2017, has already been fully invested and 40% of our capital has been returned in 1.8 years as of December 31st. This has resulted so far in a 1.2 net multiple and a 36% net IRR so far. This manager is extremely adept at executing their strategy. Important to our decision is the fact that Kimmeridge has delivered its investment returns throughout the commodity cycle and without leverage. The firm is differentiated in its direct investment approach, its in-house operations team, its deep technical knowledge, and proprietary research and data gathering capabilities. And with that, I'll take any questions.
And I noticed the difference in the fee compared to the others, 2% compared to 1.25 and 1.125.
Yes.
Is there a good reason?
Yes, there is. So one of the facts of the way that they conduct their strategy is they are doing drilling for oil. They have an in-house operations team, so it does cost a bit more in fees to pay and keep on staff the geophysicists, the geoscientists, the geologists that they have to power their research and their ability to execute the strategy. So we were comfortable with that 2% and understand that fee base. As well as we try to look at it on a comparative level to making sure that it's in line with their returns and with the high level of returns that they're getting, we felt that that was a balance.
Is it comparable to others in the same
Yes.
strategy?
Yes.
So to what extent do you investigate the legitimacy or value or supportability, let's say, of those extra expenses? Do you look at their financial statements in previous years, or do you actually examine the
We ask for the budget, their budget of how they plan to operate the fund and where those dollars are going to go. And also, Ethan, Hurley, and I did an on-site with the operations team in Denver, so we could understand who was there, what their technical capacity was, was it worth that cost to have that in-house operations? And we were frankly blown away by the quality of the people that were there and their technical expertise.
What an unconventional exploration would be.
Sure. They are fracking. So they are drilling for oil, and they're going straight down, and they're locating it in the level that they believe, that the geologists have believed that oil is present, but they're doing horizontal drilling from there, which is commonly known as fracking.
Yeah.
So can you explain this carried interest where it says the 50-50 catch-up, how that works?
Yeah, so, so once they return to us our preferred return, then we move into then the profits from the fund as they continue to come back. 50% will go to them, 50% will go to LPs until they are caught up to their 8%, and then we share.
They're 20%.
20%. So it's
20%, sorry, yeah.
Okay.
So they get their 20%.
Thank you.
And then we share the rest.
This is fine owned by, probably it says in here somewhere, but the executive manager is from Allianz Bernstein, Sanford Bernstein, and Warburg Pincus. Are they sharing any ownership, or who owns this fund?
Yes, the company is 100% owned by its employees. And the primary ownership resides with the main three partners. All right. Any more questions? Okay. Then we'll move to our next and final commitment. Just a few weeks ago, Montana committed to Center Square, to its enhanced real estate security strategy. This is a publicly traded real estate equity strategy. We wanted to let the board know that starting last year, we conducted a very comprehensive search for a REIT manager. The goal was to choose a REIT manager that would add real estate public equity exposure to our real estate asset class. We had an expansive list that was screened, and we narrowed it down to 3. of which those firms we interviewed here in Helena. Center Square was chosen for the depth and technical expertise of its team, their consistent top performance in their U.S. REIT strategy, and their lower fee structure as compared to their peers. The firm utilizes a proprietary model to assess the relative value of the REIT companies, and they combine this view with a top-down macro view of where they think real estate value is in the United States. And their approach in how they do this was very differentiated among the other REIT managers that we considered. And we decided to commit $40 million to this real estate strategy. And I'll open it up for questions from them.
So you commit, you go make a purchase of 40 because it's publicly traded, so.
Yeah, so our operations team that's led by Mike Pettit worked closely with Ethan and I, primarily Ethan, and all of the controls were set up so that this is treated just as any other public manager. We worked with State Street, the funds were transferred, and the account was opened with Center Square, and then they took those funds and immediately invested them within, I believe within 1 day they were invested. Thank you very much.
Debbie? Nope.
Mr. Chairman, members of the board, good morning. We're going to be in tab 8. We're going to spend a few minutes talking about a transition that we made within the U.S. equity asset class at the beginning of April. But before I hand it over to Randy to talk about the actual managers that were involved in the transition, and then Mike about the specifics of the transition, I just want to share a few thoughts in terms of what influenced some of the thinking of the transition. So as I'll be talking about a little bit later today under the investment update, U.S. equities has been our largest asset class for quite some time, and we've greatly benefited from that over longer periods of time, both absolute and returns relative to peers, as Becky pointed out yesterday. But we have gradually, over the last year, reduced the size of the U.S. equity asset class. It is still, by far, the largest, close to 30 or 31%. This transition we'll be talking about today took no dollars out of U.S. equity at this time. The transition, they all stayed within U.S. equity. But as we go forward, we're expecting on the margin incrementally additional dollars to come out of U.S. equity as we continue to pay the benefit payments, the net cash need for the retirement plans, as well as continuing to further diversify the portfolios. So as we put more dollars into some of the investments you just heard on the real estate, natural resources, private equity and credit side, but likely as well some of the other asset classes like diversifying strategies and high yield. So we expect to continue to head down that path, assuming markets kind of stay where they have been and valuations stay where they have been. So that thought that we have reduced U.S. equities significantly and that we're likely to continue to kind of reduce it, at the same time, a lot of those things that we're doing, I mentioned the increases in privates, but the diversifying strategies, high yield, RBK mentioned last time, we may want to consider looking at emerging market debt, which is a public market strategy. There's a number of things that Randy, Jason, and Steve, as part of the public markets team, is involved in. And so from a resource standpoint, we decided to focus more of our resources outside of U.S. equity, because we think in some of those cases, we would get more from the due diligence, active manager search. Some of these asset classes, we don't believe the way to approach them is using kind of index assets, say like high yield. And so it takes a lot of time, and we didn't want to give up on the effort. We feel we have extremely strong and disciplined